and just go see as many people as you want and have a private, semi-private conversation with the lenders to learn a little more in depth, and they've got materials at the tables on their programs. So again, thanks for coming. I would like to thank our sponsors for today, which are the National Bank of Middlebury, People's United Bank, VEDA, Vermont Community Loan Fund, the Vermont Small Business Development Center, and the Addison County Chamber of Commerce, and of course the Addison County Economic Development Corporation. So we'll get started right now. So if the presenters will come on up, we're gonna go right in the order from this end to that end. And I'll have a timer on you. We got about 7 or 8 minutes each, and we'll feel free to ask questions as we move through each speaker, and then hopefully there'll be a little time at the end for other questions as well. Well, Janice had a good idea. Could we get a show of hands about how many entrepreneurs in the audience are actively seeking financing right now?
I represent 2.
2? Yeah. So put up 2 both hands.
And I represent clients.
Great. And how many might in the near future? All the other ones. Okay.
Thank you.
Yeah, sure.
What's up, Joseph?
Sure.
All right.
I'm gonna sit here if that's all right with everybody.
Yeah, that's good.
My name's Chris LaPierre, and I'm a commercial lender at the National Bank of Middlebury. Just a little bit about our institution. We're, Will, if I say something wrong here, weigh in, but we've got 7 locations. There's probably 80, 90 of us employees, and our total asset size is $360 million, so we're microscopic compared to this guy right here. We're pretty small as far as banks go, but we can do really anything from financing your cars to your house to anything business related, credit lines, commercial real estate, machinery, all that type of stuff. And in many instances, you're going to hear from a number of these other kind of lending partners down here. We do a lot of transactions with all of these guys, and we split up pieces and can essentially get you larger percentage of the total transactions financing when we involve some of those lending partners. In a nutshell, that's about the National Bank of Middlebury.
Chris, can you outline kind of the profile of the kind of deal or lender, borrower you're looking for? What do they need to have?
Fred, it can really kind of look at, that's a great chart that you've got up there on the wall. Banks by design are a little more risk averse than, I don't know, Fresh Tracks Capital, for example. Just kind of the way we are, but we can do anything provided it's the idea or the existing business is the right one and something we're willing to invest in.
Okay, and who's next? David?
Fred. Yeah, so a bank, a lot like Chris just said, we're the former, some people's United Bank, but we're the former Chittenden Bank, which you all are familiar with, a lot of nodding heads. So we're a New England-based bank out of Bridgeport, Connecticut, with about $50 billion these days. And I will tell you, the former footprint of Chittenden is really one of the largest entities in our overall organization, which is really awesome for us. It means we carry a lot of weight with the larger organization. And our CEO and president that's down in Bridgeport, it actually lives in Charlotte and commutes home, Jack Barnes. Some of you may know him. So that's the great part about having been acquired. The other really great part about being acquired is we have a lot of all the products and services that larger banks have. And when I say that, I mean a lot of the treasury management functions, whether it's fraud services, whether it's international currency exchanging, if you need that. Any of the capital markets, we can bring a business to the market. We can do leasing, We have a full insurance lineup. We have a full wealth management services. So we really have all the products and services that you need. I will tell you how we deliver it in Vermont is different than where we deliver it elsewhere. You know, we do have the commercial lending both in our branches, as well as we have a small business lending unit, and then I tend to do larger transactions, whether they're $1.5 million or $2 million or greater. Chris Hellman, who's here with me now, raising his hand, speak with him later, is our small business lender. So we can really kind of span the spectrum of lending for you. And I would say this, while we tend to be, we don't tend to be, we are on the far right on the risk spectrum because we're getting a whopping 5% return on our money. I would say this, establishing a relationship with a bank is a really important thing to do, even if you're in the startup phase. You know, somewhere down the road you are going to need a bank, and I know at People's United Bank the relationship component is really important. I have a number of startups that I talk to. I have a number of people who are in the first year, second year of business that still aren't bankable yet, but as Chris said, we will refer them to, I'll refer them to a lot of the partners on that spectrum and help them and walk through that phase, and then when they get to where they are bankable and we can help them as a bank, I already know you and we're already familiar with you and that relationship is there. So yeah, we tend to be conservative bankers, but I would say starting a relationship with a bank, even if it's with a deposit account, is a really important thing to do.
Any questions for either of the commercial banks? Michael?
So I'm Mike Corbett. I'm with Vermont Economic Development Authority. Most people refer to us as VEDA. I actually moved to Vermont and Addison County about 10 years ago and started at the National Bank of Middlebury. Then I worked for People's United Bank, and then I came to VEDA. So I was,
He could have given all three of our presentations.
So VEDA is a public instrumentality of the state of Vermont, which is the best way that I like to describe it is we're about as close to being state employees as we can be without actually being direct state employees. So our organization was created by legislation. Some of our loan programs are written into legislation, and so they're basically state law. We, on the commercial side, which is the side I work on, so we've got VEDA and a couple of other subsidiaries on the commercial side that do loans to commercial businesses, and then we've got VAC, which is Vermont Agricultural Credit Corporation, which makes loans to farm and agricultural businesses. And Eric Hall in the second row here is here from VAC. We have a satellite office in Middlebury, and that's where Eric and I work. We live in Addison County, which is a great benefit to the borrowers here because we've got some extra market knowledge. But so the way that we operate on the commercial side is we tend to partner with banks, credit unions, anyone else that'll have us, and usually we provide the industry terminology is subordinate financing, which means we provide financing behind the primary lender. So in a typical case, a National Bank of Middlebury or a People's United Bank would be the primary lender. They would have the first mortgage, the first lien on a piece of equipment, and we would come in with a second mortgage or a second lien behind them, which means in liquidation, they get paid first, we get paid second. So we take a lot more risk in that way. But we're created to encourage businesses to expand and create jobs, which is why we are willing to fill that gap. Our kind of standard that everyone thinks of, and it's on a case-by-case basis, but it's a 50-40-10 split where the bank or credit union does 50% on the front end, we do 40%, and then the borrower comes in with 10% cash, and then usually plus closing costs on top of that. And sometimes working capital if it's a business that needs that working capital on the front end. We've got a lot of different programs on both sides, but I don't want to get too much into the specifics. I'm just trying to highlight how we're a little bit different than banks. I guess the other way we're different than banks is that we purely do lending. We don't do cash management, deposits, all that other stuff. So we're not threatening to banks in that way because we're not going to take that business from them. And we actually have, even though we're down here, our core business is down here on this end, but we do have some programs that allow us to go a little further out on the continuum. And personally, I like working with those little bit riskier businesses, and I've had some success doing that when something is deemed, like Dave said, not bankable. We can maybe come in, make that first loan to get them going, but also I always recommend that they form a relationship with a conventional banker, and they have to open deposit accounts and things like that. So oftentimes that, when they're ready, that can be a nice transitional handoff from us to the credit union that they've begun working with. That's probably what that would.
You guys are going way too fast. Any questions for Michael at VEDA?
I mean, I can get way into the specifics if we want to go back around later.
Might have to do that. All right, Janice.
So, welcome everybody. I'm Janice St. Ange with the Flexible Capital Fund, and as you can see from the continuum, we're closer towards the higher risk end of the continuum. I'm a recovering ex-banker. I actually worked for People's United Bank for 9 years down in Bridgeport, Connecticut. So, know the banking community very well, and we all have a role to play in the continuum. I'm a firm believer that everybody at this table, our role is to help entrepreneurs and businesses understand what's the right match of capital for the stage of growth that you're at, for the scale that you want to grow into, and for the market that you're selling into. So sometimes that may mean a bank loan for a piece of equipment, which is very appropriate. May mean going to a community lender to help facilitate where a bank may not be able to come in yet because you're too early stage. I think the bottom line is that there are going to be times when it may not be just one type of capital that you need, that you may need debt, equity, and anything in between. And understanding who the players are and what type of investment structures they offer is a really good start to knowing how to best finance the growth of your business. So the Flexible Capital Fund is a mission-based and investment fund. We're right now Vermont focused, and we provide what I would call growth stage capital to companies that are in Vermont's food system, forestry, and clean technology space. So we are market sector specific because our overall mission is to help facilitate building healthy food systems, preserving Vermont's working landscapes, mitigating climate change, and facilitating resilient communities. So we are focused in that arena. We are, I guess, smack dab in the middle between debt and equity. Our primary instrument is what's called a revenue share financing loan, and also known as royalty financing. And the reason that we looked at providing this type of structure is oftentimes they're going to be businesses who are poised to grow. They have a good management team and good market opportunity, but perhaps they don't want to take on equity. They may need an equity-like investment where the payback is commensurate with their cash flow, but they don't want to dilute ownership of the business, or perhaps they're never going to be high enough growth or high enough margins for an equity investment, which is essentially an investment where somebody's coming in and taking an ownership position in your business. And in that vein, if they're doing that, they're going to be looking for an exit. For folks who have this sheet on the back, there is kind of a glossary of terms that might be helpful. We've talked about debt up to this point. We are what I would call near equity investment, or we are still debt with royalty financing, but we function more like equity, and I'll explain a little bit about how that instrument works. So with a royalty loan, typically, unlike banks, we don't necessarily require collateral, so our loans are really appropriate for a company who's looking to hire new people, to bring on new staff, who are looking for marketing, dollars for marketing and sales activities. Oftentimes those are types of capital coming into that. You can't collateralize that. People walk out your door at 5:30 or 6 o'clock at night, so you can't take a lien on a person. You can't take a lien on sales and marketing activities as you can with a piece of equipment or a piece of real estate or fit up. So collateral is less of an issue for us. Oftentimes, banks will require a personal guarantee, which typically is either secured with a second mortgage on your home or your firstborn child. But I'm just kidding. But in any case,
You can keep the kids.
you can, yeah, that, you don't want.
And you can take mine too.
So we are less collateral based. We're more focused on the opportunity going forward than the historical operating situation of the business. So we take a forward-looking perspective, and that's why we are closer to an equity investor than a commercial lender, primarily because we're looking at the strength of the team as the number one piece. Outside of the first component is you have to be within our market sectors, but outside of that, the first thing we're going to look at is the strength of the management team and the ability to execute. And the second thing we're going to look at is the strength of the management team and the ability to execute. And the third thing we're going to look at is the strength of the team and the ability of the management team to execute. And here's why, because you as entrepreneurs are the ones who are going to make it happen. And if we don't believe in you, if there isn't integrity, and if there isn't an ability to learn and listen, and to really, and to see that the entrepreneur knows their market and is willing to grow that business in a way that is smart and is taking advantage of the opportunity, then it's probably not something we're going to do, because we are relying on revenues to pay us back, hence the name royalty or revenue share financing. So if we lend $100,000 to the business, and I'm just going to, for math's sake, I'm going to say we're going to ask for $200,000 back. 2 times our money, which is going to be less expensive than what an equity investor would be looking for, typically an angel investor. And Maurice can talk a little bit about that role. And that's typically 3 to 5 times their money over a certain period of time. So we're more patient. 2 times your money may sound like a lot, but sometimes we get paid in 5 years, sometimes we get paid in 10 years. So if anybody has done Finance 101, it's the time value of money. So we're willing to be patient. We don't take an ownership position, but we can defer payments for the first year for our business. So like equity, where you're not having to repay initially, we want to give the business a chance to get off the runway and up and fly it in the air. So that's kind of where we fit. We do, as I mentioned, work with growth stage businesses because our primary instrument is being repaid by revenues. If you're a startup and you don't have revenues, kind of defeats the purpose of doing a royalty share payment. So we don't work with startups. So I want to be clear in that arena. But again, we're an alternative to equity. Oftentimes, though, we can come in with another structure, which is just a straight term loan with a much smaller equity component if the loan is a little bit riskier. And I think you'll be hearing from Jordan Benjamin of Aquavite later a little bit about their financing package, and so they're one of our portfolio companies. And that was a little bit different structure, but it's fit the needs of the business and their cash flow as they were poised to grow. The only other thing I would say is it's not just about the money. When you're looking at how to best finance your business, think about what those lenders, investors, funders bring to the table. Because for us, we're, again, a big believer in bringing business advisory capacity and instant access to our networks. So understanding, in addition to the money, what kind of technical assistance can that lender or investor bring to the table if you need help with marketing, or if you need some advisory capacity on a particular issue related to your financial assistance. We bring that to the table as we are what's called a Community Development Financial Institution, a CDFI. So we have grant dollars that can augment our loan dollars to help facilitate business advisory capacity for our borrowers. So that's one thing I think that also sets us a little bit apart. We're not for everybody. Again, growth stage businesses in the market sectors that we're in, but we can be an integral part of an overall financing package where we're playing that last role of coming in where there's no collateral left, or you may be able to get equity, but you don't want to dilute ownership of the business. So we're kind of that higher risk, and we're higher reward on the continuum, not meaning that we're going to be the most expensive, but we're going to be more expensive than traditional bank debt, less expensive than equity investment, where that's requiring an exit strategy. So I guess I'll leave it at that, and we can talk a little bit more.
Thank you, Janice. Any questions?
Sorry, Janice, what market sectors are there again?
So food system, which is pretty broad, everything on the spectrum of the farm to plate spectrum, where, with the exception of production, farm production. And then forest products and clean technology, again, pretty broad. So we've done waste management, renewable energy, environmental technology, pretty broad.
Thank you.
Yes.
Is your fund privately held?
We are an interesting hybrid, I guess is what you would say. So we raised equity investment to fund the fund because how our money comes in dictates how flexible we can be in it going out. So we didn't want to raise debt ourselves. We wanted to be able to be flexible and be able to defer payments, be able to take a longer horizon in our investments. But that being said, as a CDFI, we also have access to U.S. Treasury funds. So we get some of our loan capital is from the CDFI fund, and then we've raised about $3.6 million from investors to facilitate flexible capital going out to businesses in Vermont.
Any other questions for anybody that's presented so far? All right. Dan.
All right, I'm Dan Winslow. I'm a loan officer with Vermont Community Loan Fund. We are based in Montpelier. We lend all over the state of Vermont. We do business loans to child care, early care and learning centers, to farms, to forestry-related businesses, to just normal everyday businesses like manufacturers, and also to local food businesses. We are a nonprofit. We're also a community development financial institution, and so while we sometimes partner with various government agencies, we're not a government agency ourselves. We do loans for working capital, equipment, commercial real estate, things like that. We often are in partnership with many of the other entities in this room. We can do loans I've done loans as small as $5,000, and first-time loans are usually around $350,000. We are looking for typically three things when we lend. The first is mission impact, so that would be, does this support or preserve or create Vermont-based jobs? Does it support Vermont's working landscape, the agriculture, food economy, the forestry? Does it support, preserve Vermont downtowns? Those are the mission impacts, types of mission impacts we're looking for. We are looking for businesses that, even if they're just a startup, that we'd like to see how they're going to be able to generate cash flow to pay back a loan. And we do ask for collateral as well, though sometimes we can lend out on collateral a bit further than a more traditional lender like a bank might be able to. We have interest rates for normal business loan. I think the current average is 7.5%. If you're a food, farm, and forestry related business, we have various sources of funds that are cheaper to us, which means they're cheaper to you, and those can sometimes be down to 5.5% or lower. We also have a program that if you're a very startup business, let's say you only had like 40,000 or 50,000 in revenue, you're really at an inflection point, or you've been a business that's been around a while at a small scale and now you're trying to grow, and if you're in food farming or forest field, we have the Sprout Loan program, and that would be, terms would be 1% interest only for the first 2 years, and then 2% principal interest for 4 to 5 years after that. But that's really for people who can't get a more traditional loan, or even a loan from us that would be on more standard terms, just because of the stage of where your business is at. I think I hit all of my main points I wanted to talk about. So,
Any questions for Dan? Just to give the others a heads up, since we're ahead of time, after Lori and I go, We'll go back down around. If you could just talk a little bit about some of the commercial products that you have, and you can talk about terms and rates and things like that. And anything else you can think of about your institution and any of the other lenders that are in the room? You get ready to give a couple minutes on what you do. All right. Go ahead.
All right, hi, good morning, everyone. My name is Lori Staligman. I'm not a banker. I've never been a banker. I've never worked in a bank. What I'm doing in the realm of entrepreneurial support, I'm further to the, what is that, the right in the equity box. And I love that chart, you know, it's great. So I run a small micro fund called Vernal Ventures. It's focused on companies solving environmental problems, primarily in the food and energy space. And I'm here today wearing the hat of angel investor or micro fund manager. And the logic that we use is pretty similar to that of a venture capitalist. Are people familiar with the term angel and venture capitalist? Is that? Yeah, okay, sort of. So with angel, the difference is, one is a venture capitalist is managing somebody else's money. They have to adhere to different rules. An angel investor would be an individual who has his or her own money to invest. And as much as any two humans are different, all angel investors are different. So it's hard to talk about rules, but there are generalities. Microfunds and angel investors come in, it's a special kind of capital. So it's like if you have a software company and this thing is going to take off, and you know it's going to take off, and your goal is to grow this big, and you see this growing 10, 20, even 30 times the size it is today. But, you know, man, you need that marketing person. You need sales reps regionally or on the West Coast. And a traditional lender just can't help you with that. What you would do would be to sell a piece of your company, an equity stake in your company, to one of the players, you know, on this far end. You're giving up control, but ideally you're finding an entity or a group of individuals that has something else to offer in addition to the financing. So they might have expertise, they might have connections. They are also going to sit on your board. They're also going to tell you what to do. They might tell you in 3 or 4 years, you know, you're not the right person to run this business anymore. We need a more professional CEO, someone who's taken a company from this size to this size. The final thing that they'll be looking for, and you need to think about alignment, is they need something called an exit, which sounds awful and cool, but we need to get our investment out. And so if you're not paying back the loan every month or doing it through royalties, how does that happen? And 99% of the time, it means you're selling your company to larger entities. So at the time that the investment is made, there's a value that's put on your company, and then the hope is that it grows, you know, with hard work and effort and everybody's growing in the same direction, it grows to a much bigger size, and you sell it. And then you are no longer involved in that company, or maybe you're retained. So if you're someone who you're like, you know, I've got this great food product, and this is what I want to do, this is where my heart is, this is not for you. Or you'd say, you know, I want slow and sustained growth, I'm not looking for that. The best description I've heard of this kind of capital is, it's like jet fuel. So if you're looking to build a jet, it could be a really good fit. But if you're building something else, there's a lot of strings that are attached that just might not be for you. And then I'd be happy to walk you through the process if you think there's a fit, maybe when people talk about their commercial products. But any questions?
What size?
What's that?
What size investments do you guys make?
Typically, it depends on the business. You know, everything, it depends. So we work with Clean Energy Venture Group and Branch Venture Group in Boston. So an entrepreneur would come in, pitch a group of maybe 10 to 20 people. The average check would be about $25,000. Some would go up to $100,000 or $200,000, but the idea is start building that relationship, and then everybody anticipates a second raise. So that first chunk of money is to get you to certain milestones, and then the next chunk of money would be for additional milestones, but at a higher valuation. And then at that next level, or the next level, maybe a venture capitalist would come in, writing the much larger checks of several $100,000.
Got a question. So I've got a business and I started in my basement, and all of us, and I'm having a great time and I'm selling to my friends, and suddenly somebody else wants some and somebody else wants some, and now I've got all this demand. And so my only time to figure out how to grow my company is between midnight and 5 a.m. And so I don't have a lot of time to wander around and ask people how I set this up. Where do I start? Where do I start in trying to figure out how to get my business out of my basement and into a real facility, and becomes a real business? How do I make that step?
Small Business Development Center.
I was going to say our office. We're
Yeah,
Brian.
exactly. Starting within the context of your region, the regional development corporations like Addison County, and then the SBDC advisory capacity, we are very, very fortunate in Vermont to have this network of people and good advisory capacity that doesn't cost anything.
So thanks for queuing that up. So I was going to say we should be your first stop. So again, I'm with the Addison County Economic Development Corporation, not a banker, also not, but we do lending. But we're your kind of one-stop shop for business services and programs. We offer a broad array of services, free. Most of them are free. Once we get into some, really in-depth counseling, there are fee for service, but most of what we do is free. We are a member-based organization, so you can, we provide services to the business community, but you can also join, and there are another level of services that you can get because of that membership. We're one of 12 regional development corporations in the state of Vermont, so we partner with the Agency of Commerce and the Department of Economic Development and all these partners that are here today to provide services. So we're able to network and connect you to all of the local, regional, state, and federal programs and services that are out there. And because we have folks like Brian DeClue back there from the Vermont Small Business Development Center who's co-located with us, we also have people from and we're going to get into alphabet soup here, but other state programs like PTAC, which can connect you to state and federal contracts, and with VMAC, the Vermont Manufacturing Extension Center, they all co-locate at our office sometime during the week. Brian's there on Tuesdays. So we're able to connect you to those services, but also the whole array of federal and state programs that might be able to help your business, and be able to sit with you and help you decide which ones are the right services and programs to try to access. And then we'll bring them to you. You don't have to go chase all over. And one thing we do very often is if we're working with a business who's trying to put together a finance package, we'll bring all the lenders, people from this table, to our office, and you can meet with them all together. And then in addition to connecting you with those programs, and just some examples, like there's lots of USDA loan and grant programs, so we can connect you to those. Sometimes we can actually be the applicant on your behalf, depending on the program. We can also provide assistance with your applications to those programs. And on the lending side, our organization was the first Kiva ZIP trustee. Kiva is a international crowdsourced microloan program that has 0% interest. But we're not lending to you, but we're helping you use that program that does very small loans, and the money is actually getting crowdsourced from all over the world. In addition to that, we are a direct lender. We have our own revolving loan fund. that makes small loans that are very flexible, but we also have, we're an intermediary lending program from the USDA. So the USDA lent money to us, and we can re-lend it to the business community. So those loans can be a little larger. We can go up to $100,000 on those loans, but there's a few more restrictions on those types of loans. We're not a primary lender, just like the Community Loan Fund. We're usually in second or third place in a deal stack. So we're providing loans to people who can't get commercial loans, startups sometimes, or other businesses that just don't have the profile to get a commercial loan, or we're providing gap financing. So there's usually, there might be a commercial bank, VEDA, Community Loan Fund, and us. So our loans are they're fixed rate loans. They're $5,000 to $100,000 limit, and the terms depend on the project. They depend on the collateral. We do require personal guarantees. The loans have to be used for the establishment of new businesses, expansion of existing businesses, or creation of employment opportunities, or saving existing jobs. And we have a broad spectrum that we can lend to, but like some of the others, we can't lend to agricultural production. That's because we're getting our money from the USDA, and they have other programs to lend directly to ag production. So we've lent, and the other restriction is our lending has to be to a business that is located in, or the project is located in, Addison County, because that's our service area. So some of the other RDCs like ours around the state also have revolving loan funds. So we loaned about $5 million to about 100 Addison County projects over, since 1998 or so, including a couple of the businesses that you'll hear from in a few minutes, Aquavite and Stonecutter. So that's our program, and again, but we provide a full service, so lending is just a piece of it. So you can come into our office and we can talk about anything to do with business and then get you connected to the right resources. Any questions for anybody on the panel? Answer all your questions. All right. So let's start back around again. If you guys want to just talk about some of the products that you have and
Some of the products.
commercial products.
I guess I'd maybe start with just kind of, when you distill down the operations of a bank to what we do is you all bring your deposits to us. We pay you X on those deposits. We pool that money. We turn back around and lend those dollars back to those same groups of people at X plus something, keep the lights on, and then hopefully gives us some net income at the end of the day. In a nutshell, that's it. The rest is kind of just details and regulations. In that, on the lending side of things, kind of the basic rules we're going to follow. Number one, we're looking for you to have kind of quote-unquote skin in the game. So if you're buying a piece of commercial real estate or you're buying a machine, we're going to look for you to have X percentage down. It's typically 20-25% on machinery, things like that. When you start talking bigger transactions, that's where we're going to involve the VEDAs of the world, understanding that down payments can get pretty sizable when you're talking 20-25% of $1 million. The other thing we're going to be looking for is kind of the rates and terms that we can offer you. So there's, on a commercial loan, there's typically a number of rate options. You can have a variable interest rate. You can have fixed interest rate for a period. So going back to my initial comment, we don't know what we're going to be paying you on deposits in 5, 10 years, something like that. So we may offer you a 5, 7, 10-year fixed rate of interest on your loan, but it's going to typically be a bit higher the more extension risk that we're going to be taking on whatever loan we're proposing. Dave, what else can I say? Evaluation of ideas generally is really a big part of it, and I probably should have touched on that initially. I mean, We'll get involved with startup transactions, certainly. If you come to us and say, hey, I think horse-drawn carriages are going to make a comeback and I'm going to start building them, we're going to ask you a lot of probably difficult questions compared to something food service related, something, anything like that. Rates and terms, Fred, a bank in other ways is like any type of business. The more volume you're doing, the more dollars you're borrowing, the better the interest rate is going to tend to be compared to a smaller transaction. The more experience you have, the longer time you've been in business, the stronger the entity that's actually borrowing the money, the better terms that you can generally get. Fair statement?
Yeah.
So question, from the time that I get to your desk with a complete loan package that you are satisfied with, how long before I get an answer? Is it 30 days? Is it 6 months? I mean, how long? And again, and I've got to give you all everything that you want.
I
And
hate
how
to
long?
answer it depends, but it depends. Okay, so oftentimes if we're financing real estate, you have to make sure the permitting is in place, that's outside of our hands. You have to have appraisals done, that's outside of our hands. We have to have title searches done on real estate. We can, I would say typically on a real estate or any transaction, we can probably have you, I'm going to say a contingent
Conditional
yes
commitment letter?
within 2-3 weeks. Those contingencies are typically all the things that I just said. If you're buying a piece of property for $1 million, it needs to appraise for $1 million. If it appraises for $700,000, you got the money.
And so a number of times we can make, maybe the permitting or the appraisal or the environmental due diligence contingent, and we can give you a commitment contingent upon those successful completions of those. But, it depends on how thorough your loan package is, and many times there's questions that we'll need to go back and forth with you on. So, the more information you can give us up front, the less questions we'll have. Typically, the quicker we can turn it around for you.
So you'll provide me a list of things that you want me to bring in a loan package?
Absolutely.
Last 3 years' tax returns, your current financial statement, what your dream really is, a contract if you have this property. So is that right? That you'll give me some heads up as to what I'm going to need in a loan package?
Yeah, and you pretty much, it's going to be 3 years financials for both you and your business. Any interim financials, if we're midway through the year, a personal financial statement, we typically will require a guarantee. And the other thing I would say is, depending on, a bunch of us raised our hands when we talked about it for a startup. And a lot like Janice said about SBDC, that business plan is an all-important document, and you can't spend too much time doing that document and being thorough with that, because that really it's our roadmap to understanding how you're trying to make a dollar, right? And so the more thorough you are with those projected financials and detail on how you're going to actually make money is really important. And I know, so Janice and I used to sit on the board of SBDC for many years. I'm a huge fan of this organization that's really, Brian, it isn't super well known, so SBDC is there for you. Addison County Economic Development, which I sit on the board now of, is an awesome way to connect you with all of us. So make sure that when you're going out and starting a business, those people are on your radar, because they'll save you a whole lot of time trying to figure out the right way to go. Make them part of your team. Like I said before, make a banker part of your team. Make sure that those resources are part of your team also, because they'll save you a ton of time. So banking in general, and I'll just, and you probably know all this, but I'll just say it just for my own edification, but typically banks are looking for strong cash flow or cash flow and then probably cash flow, and then cash flow, and then some type of collateral, right? And so when I talk about cash flow, what I mean is the net income of the business, and we'll add back depreciation or amortization if that expense is there, add back the interest and the interest expense you may have paid, see what that number is, and then compare that number to your principal and interest payments, and we're looking for a 20% cushion in that number. So in the banker's terminology, we call it 1.2 times debt service coverage. So that's that free cash flow that you have. See how that compares to what your debt payments would be. And so that's a really important ratio for banks. And then, like Chris said, you know, we'll collateralize it. Typically, we'll lend 80% of real estate. We'll lend, if it's a line of credit, typically it's 80% of account receivables that are currently aged, maybe under 60 days, if they were a line of credit. We'll lend typically 40% or 50% of inventory. But that's how we get at the collateral component. So just in real basic terminology, it's the cash flow and then collateral. Those two items are really important in our analysis, along with everything else.
So business does need to be profitable, even profitable to qualify for a loan.
It's hard if you don't. I mean, so what Chris and I will do, we'll bring in a potential SBA guarantee, or we'll bring in VEDA, or we'll try to refer to some of the other opportunities. But yeah, for a senior lender like us, it's really difficult. Is that fair? Very, yeah.
What kind of credit score are you guys looking for?
Kind of credit score, I'd say high 6s up are probably ideal. And I don't know, Brian, I don't know off the top of my head what credit scores can range from, but 800 to somewhere in the 5s is probably the range of possibilities.
And I don't know if I have an answer for that one. Typically, I'm, like I said, larger companies, larger transactions. So it's not necessarily the focus, but certainly your personal credit history is going to be potentially reflective of how you do in business. So if you have delinquencies and you have past due accounts on your personal credit bureau, it could be potentially alarming, right?
We're doing shout outs, you can do the Burlington City Marathon too? Or?
Okay. Yeah, Burlington City, if you're runners, you already know.
Dave heads up the Burlington City Marathon sponsorship for people, so that's what I was thinking when I see you, is that you're going to want me to volunteer for. VEDA, I guess just to add on to what these guys said, because I'm trying to further recover from being a banker, but I've only been out of it for a few years. I think the struggle that Chris was trying to describe is, you know, if you're able to be conventionally bankable and work with just these two guys, and you don't need any other partners, or you don't want any other partners, sometimes you don't necessarily need them, but sometimes you just don't want them. You can get really nuanced with the flexibility of, you know, if you want to do a loan that, you know, you make a payment every third month that's got a 3-year AM and a 7/1 amort, you know, you can get really complicated. But then I think the more you get into the credit enhancement type lenders further down the table, we've got programs and we don't really deviate too much, and can't, VEDA, for example, on some of our programs, it's written right in the statute, so we just can't deviate from that. So we give you more canned programs. We may be very flexible with collateral and things like that as far as if you qualify or not, but you know, the reason that I can give you, our rates and terms on what we offer is because we're program lenders, and a lot of the other lenders here that aren't banks or credit unions are program lenders. But when you're in a bank, I mean, you can negotiate every possible thing you want. Your deals get really sophisticated, and you've got people negotiating everything possible. So that would be one of the differences, I think, as you move down the continuum. So I wrote down some, try to keep it pretty brief, but So yeah, just a couple of things I didn't mention before. You know, we are also a nonprofit mission-driven lender, so the mission matters to us. The job creation matters to us, and it could matter so much that that could be a difference between approval or not. If it's a tight project where we're relying on projected cash flow, but there's really strong job creation that are going to be, you know, good jobs for the state that have benefits and livable wages, that can make a difference to us. One of the things about me personally, and I think about all of our other lenders, but I don't really work with them in this capacity, is that I do my best, although I still think, you know, Fred would be probably the first resource in this county for this, but if I can't do it, I'll try to find someone that can or will help you do it. You know, I rarely, even I think the bankers in the room, rarely do you ever just give a straight denial. You would say, you know, this is not something that really works for us, but here's a couple of options you could call, or let me call them for you and set up a meeting. I think we've got some really good people in this room that really care about businesses in the community growing and prospering, creating jobs. So our rates, terms, etc. We've got a couple of different options. Some of our programs offer a fixed rate, some of them offer a floating rate. Generally, right now, because of the yield curve, that rate is around 5% fixed or floating. So if you don't understand what floating means, that means you're tied to an index. So as that index changes, your rate changes. So it may be, we don't use Wall Street Journal Prime, but that's just what everyone thinks of. If you're prime plus a half, and the prime goes up, then your rate just went up that day, and that's impacted in your payment. Usually, for you taking that risk of a payment, your rate is lower, and the fixed rates, like Chris said, are higher because it's harder to predict what our cost of funds are going to be as time goes on. But right now, for us, the way we look at our cost of funds, it's about the same. So our small business program is one of multiple programs I'm going to briefly discuss here. Small business program is capped at $500,000. We usually do that in partnership with another lender, and that's where we would do up to 40% of a project capped at $500,000. The fixed rate on that, and there's also economic development components of this, which are really project specific, so I'm giving you the higher end of the rate, but I think our rate as of Wednesday was like 5.58% fixed for 5 years, which, you know, might be, is probably a little bit higher than what you get at a bank or a credit union, but that's because, remember, we're in second position on all the collateral, and if the project fails and the bank only sells it for enough to cover their loan, we don't get any money back. Another program we have is called the Direct Loan Program. That is the one that's written specifically in the statute, has specific industries that we can lend to. It's pretty broad, but the sweet spots are hospitality, which is interesting because, you know, that's a hard industry for a lot of places to lend to, but the state of Vermont values the hospitality industry. It's important to us as a state with all the ski resorts and other things, now with the beer tourism as well. And so we have a program that specifically can lend to that industry. We can go up to $1.5 million in that program, so if you're one of those qualifying industries, you can go up to $1.5 million. And that's on our piece, which would be up to 40% of the project, so a project can be quite a bit larger. So then we have the Entrepreneurial Loan Program, which is a program that we created to respond to a need that we heard from some of the tech sector in Vermont, which is a small but growing sector of the state. Those businesses are hard for conventional banks to finance because they oftentimes don't have hard collateral that you can really kind of dig your teeth into. They've got intellectual property, they've got other things. You know, their value is really those engineers and things in the back room that are putting out the product and keeping it up to date. And so that's our, on the continuum, that's our kind of riskiest program, and accordingly we have a higher rate. It's prime plus 3 floating, so prime is 5.5 right now, so it's 8.5% floating. Still cheaper than equity probably. And that, you know, we've kind of massaged that program to where we would put in other pre-revenue startups. They don't necessarily have to be tech sector, but, you know, as these guys were saying, to make a loan to a pre-revenue company, you really have to have a really strong case as to why we would do that. You better have a lot of research and development, a strong business plan. be fairly certain that when you go out into the world, this is going to work out. So we'll make loans as early as that stage. Those are three. Then we have a 504 program, which is an SBA program. Kevin Morehouse is here from the SBA. There's a great resource of people in this room if you have time to stick around and talk individually. So the 504 program is a program that we basically underwrite for and then move it to the SBA, and then they sell it on the secondary market. But the benefit of that program is similar to our other programs where we do equipment and real estate, but the 504 offers a long-term fixed rate, probably the longest term fixed rate on the commercial side anywhere in the country. You can do a 20-year or a 25-year on real estate. That's a fully amortizing, so the rate would be fixed for that 20 years or 25 years, and it would amortize over 20 or 25 years. And then on equipment, you can do 10 years. And the 25-year rate is the all-in rate, somewhere around 5% right now. So you'd have a 25-year fixed rate at 5%. There's a lot of hurdles you have to clear to qualify for that program, but they're not outrageous compared to what any normal loan requirements are. A couple of other things about VEDA. Typically, anything we do internally, we're going to have a 10-year balloon on, so your amortization will often be longer than the term of your loan. So we might do on real estate a 20-year amortization, which means your payment is divided over 20 years and made monthly. And the loan actually comes due in 10 years, so you'd have a big payment due in 10 years. And typically what happens then is either we have an opportunity to roll that over internally, but it gives us another chance to look at the business and evaluate, make sure everything's going the direction we want it to. It also gives you an opportunity to say, hey, I don't need VEDA anymore because I got them when I was early, and it's been 10 years. We've grown, we're strong enough now. We're going to ask if one of these conventional lenders or the other conventional lenders in the room will refinance VEDA's balance into the existing balance that we have at a lower rate, and move on from there. So, it's not always our intention to be with a company forever. A lot of times we're necessary or asked for on the front end to keep the down payment down, and then over time we kind of phase ourselves out. And we do not have a prepayment on any of our internal programs. 504 program does have a prepayment penalty, but internally we don't have any prepayment penalties. We do require personal guarantees for any owners of 20% or more of the business. That's kind of the industry standard. Usually if you own 20% or more, you're asked to provide. We ask for an unlimited unsecured personal guarantee, which means we don't have any direct claims to your home or any specific assets, but you are backing that, and we can, through legal means, go after those underlying assets. On rare occasions, when we really feel the need, we will ask for a secured guarantee. We might ask for a second mortgage on the home or something like that. The other thing a couple other programs we do, we've got a Subfree Program, which is where we lend to the regional development corporations like ACEDC to either create an industrial park or build out a building in an industrial park, either for a specific tenant or potentially speculative tenants. So that would be where either the business isn't far enough along to be able to qualify for that loan themselves, but it's a meaningful enough company that looks like it's pretty likely going to create some good jobs, and in partnership with the Regional Development Corp, they come to us. The Regional Development Corp actually owns the building and leases it to the tenant, and we can finance a project like that. And then a lot of times those end up being capital leases where at the end the business buys the real estate from the RDC. But some of the RDCs in the state, that's a lot of their income is that they own buildings in industrial parks and lease them. And there's a lot of businesses out there, especially when you get into much larger businesses that don't have any interest in owning real estate because it doesn't look good on their balance sheet for investors or other reasons. Some companies can't get, it's a lot easier to get operating expenses approved in a budget than it is to get capital expenses approved in a budget. So if you are based out of state and you've got to make these requests from management out of state, it's easier to just request a lease than to request buying an entire building. We do energy lending, solar, any sort of renewable energy, along similar terms and rates and structures that I already mentioned. That's another one of the things that the state has tasked us with, is trying to hit their renewable energy goals. There's some very nuanced programs out there, new markets, and now opportunity zones. We found a way to get comfortable and get involved with those. some of you in the room, Brian, I know you explored that. And I think that's about it. The one other thing I would mention is that we really need to lend to an operating company. So we can't really lend to a passive real estate investor that just wants to buy a building and wants to rent it out. If there's, with some exceptions, so if you wanted to kind of act like an RDC would, and you're really doing this for the benefit of the underlying tenant and to the community and to the job creation, and we can justify that, we may be able to do that to a private developer. And the other exception is if it's kind of in a historic downtown or in an important downtown area, then we, on occasion, have been able to make that exception. That's kind of what we do. And then we've got a whole separate arm of Vermont Agricultural Credit Corporation for anybody that's kind of value add, food, or on the production side from agriculture that I don't ever get into debt per cow or anything like that. But that's, Eric can talk to you if you have questions.
Janice?
So I did want to just clarify, even though we're on this side of the continuum, we are, by nature of our name, flexible capital. So we're not a programmatic lender. We don't have a program per se. We can pretty much structure our loans any which way to Sunday, and of the 21 loans that we've done, they've all been different based on the capital needs of the business and the risk profile and the market opportunity. So we're very flexible. We typically, the range of capital that we provide is anywhere between 100 and 400,000. We can go higher than that. We have what I would call a core group of, in our network of other like-minded mission-based investors that we can work with and bring in to round out a particular dollar amount if the capital is more, if capital need is more than 400,000. So we do what's called participation loans, where we can bring in other investors to participate in our deals, such that the company can get more than what we can do. And we'll play the lead, we'll do the due diligence and work with the other investors. We can service it on the back end. We work with the Vermont Community Loan Fund in relation to some of our servicing on our straight term loans. So we are really about partnership and collaboration. So we've been in the capital stack with, again, just about everybody at this table. I think that's the value of being in a place like Vermont, where we know each other for the most part, and we know each other's programs. So you as an entrepreneur don't need to do in-depth research on all 20 types of capital that are out there. Hopefully, we can all look at the opportunity and say, okay, if it's not a fit for us, who might it be a fit, and then make that introduction like Fred was talking about. I think that's what I particularly like about being in Vermont. We have that ability to do that together. And I guess the only other thing I would say is if somebody, I'm sorry, I forgot the woman. Elizabeth, you had asked about timing, right?
Yep.
So here's my tip. If you need capital today, don't come talk to me. Okay? If you need capital next week, don't come talk to me. If you need capital next month, don't come talk to me, because I can't help you in a month's time. Raising outside capital beyond friends, family, and fools, you really need to think about the time frame of how long it's going to take. Some debt providers have programmatically the ability to turn things around pretty quickly, and that's great. But for the most part, if you think it's going to take you a month to raise capital, it's going to take you 6 months. Especially on the equity side, more than that. It'll probably take 3 times what you think it will take to find the right investors and that are in alignment with the values and how you want to grow the business. Plan ahead when it comes to raising capital, and not just for the round that you need today, or next month, or actually next 6 months. Think about how the capital that you take on today is going to impact your ability to raise capital the next time. Because if you're growing your business, chances are you're going to need another kind of capital to continue that growth, to continue to hire people and do marketing and sales and take on new equipment. So how you structure your capital, your financing today can impact the type of money you can take on in the future. So again, plan ahead. If you're gonna give yourself a month, if you know, a business comes to me, well, I need money in 30 days or we're gonna not be able to make payroll. I'm like, you should have thought about that 4 months ago when you knew you were heading into that. So having projected cash flow, doing a budget, looking at planning ahead, probably the most important thing that you can do for your business.
And that's again, that's another thing Brian can help you with. It's not only a business plan up front, but projections, financial projections.
Yeah, actually that ties into one thing I wanted to say is when I look at projections for a startup business, if they've been prepared by someone like an SBDC or some other entity that helps with business planning, it really allows us to give them a bit more weight than if someone's just throwing numbers at a wall. And so that's very important. And one other thing I'll add real quickly is that through Weaken partnership with various government entities like the SBA and their microloan program, that allows us to offer business advisory services after a loan closing. So it's not simply that we give you the money and then send you on your way. We can be another pair of eyes to kind of help you come up with some solutions as you're trying to grow and run your business.
Anything else to add?
Yeah, I'll add one more thing, just to highlight the differences between traditional banks or non-traditional banks and equity. The number one thing we're looking at is the team. Who's on the team? Do they work together? Have they handled adversity together? Can they carry this business to the finish line? So although the product and what the idea is today, it does really matter, there's the expectation that there will be a pivot, there will be a change. You know, we've got this type of baby food, we'll remarket it, you know, whatever, we'll hit the toddler market, and these are actually things that have happened. So we're very much interested in the team and looking towards the future. And which kind of goes along with the type of risk that equity investors take on.
The only thing I'll add about our lending is just some details. We do 5, 7, or 10-year terms depending on the project. You know, the higher terms and more for the real estate deals. Our rates are fixed right now at 7%. It's a little higher because we're in third position, taking usually the most risk. And I think Michael mentioned the typical setup is like 50%, 50% commercial bank, 40% VEDA maybe, and then 10% owner equity. And that can shift around a little. But another thing about our loan is it can be part of that owner equity piece, if you know, depending on the circumstances and the details in the deal and the project. All right, so let's, unless there's other questions or.
Can I just add one thing?
Sure.
I think it's important when are raising capital, in addition to planning ahead and not expecting to get capital the same day you ask for it. I think the other big piece of advice I would recommend is do your own due diligence on who you're going to be taking capital from if it's your first time raising outside capital. Because when you get that check and deposit it, now you've got other people in the marriage, so to speak. And if things go south, which inevitably every business has bumps in the road, you want that partner to be in alignment with you, to be helpful, to be, I guess I would say, flexible when things go south. So I guess that's the only other advice I would say is know who you're taking capital from. And understanding how they act when things go south. Because you want a partner to help you all along the way of your business, not just for that one transaction.
Great, thank you. David.
Quick question. Talked about size of the loans with you guys until Dan. I wonder if you could talk about typical size of the loans you guys do?
Ours are typically 50 to 75,000. Our top is, our max is 100,000. And that's on the USDA revolving loan fund. We have our own revolving loan fund, which we typically do $10,000 to $50,000 loans.
Yeah, and an angel investor, an individual might go in, the average number is 25,000, but it's best done, these types of investments in a group. So you would look to get around 100,000 to maybe 250 at the very most. And then the way it works is different groups syndicate with one another. And so you could get, I don't know, around 500,000 of a round filled out through those types of relationships.
Did you already cover?
Yeah, I
these?
had said, like, we do as small as 5,000 to usually up to 350,000 for a first-time borrower. If we really like you, we can maybe do more than that on a first-time borrower, but that's the typical.
All right, so let's take a 2-minute break, get some coffee, stretch your legs, and we'll come right back. We're going to hear from Sivan Cotel from Stonecutter Spirits and Jordan Benjamin from ACCoC about how they put together some financing or something. You guys take your water bottle. If not 80% of them. So we're going to let them tell you their story, and there'll be plenty of time for questions. Thank you, gentlemen.
Thank you, Fred. Hey, everybody. We'll start to a little bit about ourselves, and then we'll talk a little bit about how we actually finance Stonecutter and Hawaii, and then we'll try to just leave some time for questions, because that's, I think, usually the most constructive part. So I'm Sivan Cotel. I'm one of the founders of Stonecutter Spirits. We're here in Middlebury on Exchange Street, and then we also have a bar and restaurant in Burlington called Stonecutter Spirits Highway Social. We are 5 years in. Personal background, talking about that, probably not going too much into the Stonecutter part. I began my career in New York. I worked in finance in New York for a number of large financial institutions before I moved here. And I moved here to be the number 2 at WhistlePig in WhistlePig's early growth years. And then after leaving WhistlePig, my now business partner and I started Stonecutter. And we have, as Fred said, used kind of everything on the spectrum. So happy to talk to all of those. When we come back and talk about companies. Jordan.
Thank you. And welcome everyone. I think it's a good start in learning about financing, just to get out and focus on the business, which is what you're doing here, versus head down in it all day. That's the first step. I grew up in Middlebury, left in 2009. I was away went to school in Boston, worked in finance in Boston, came back in 2009. So I was gone for about 9 years outside of Vermont. When I came back, I was the second employee of ACEDC. Jeff Weaver is the founder, and it was, it's pretty typical, and I love sharing the story, but it was in his basement, literally, and brewing kombucha down there. Now, how many of you know what kombucha is? Raise your hand. That's good, because because I remember Jeff started a farmer's market in 2007, but one of the first banks he went to was National Bank of Middlebury, and I'm pretty sure no one knew what kombucha was at the time. Certainly none of the bankers did, so it was an uphill battle from the start. Yeah. What else, I guess? We can talk back to you. Yeah.
So I'll tell you a little bit about how Stonecutter is financed, and it's been a journey over the 5 years for sure. And when we actually take question and answer, I can answer it from experience for other parts too, because we did other things along the spectrum as well back in my WhistlePig days, and I've worked on a couple of them. So as with many small and growing businesses, we have been down to the wire many a time, and that is, I want to say always exciting, but that's not how it feels. It always feels, you feel it in here. I'm sure many people in the room know that feeling. We started the company with every dollar personal money that we could scrounge together, and the goal was to see, could we get through with that and then loans before we ever asked for an outside equity dollar. Not always possible, but the goal for us was, can we get to the point that we have a real product out and someone could hold it in their hand before we ask for investors? If so, we thought that it was incumbent on us to take the riskiest position, which is the earliest stuff. Can you even get to market? And we thought that by that point, when you're raising equity, you should be in a better position if you have something real, rather than asking folks to believe in something that doesn't even exist yet, right? The later you can wait to ask for the investment side, the more likely you are to at least be something tangible people could understand what it is, and should probably be better for you as an owner. So we started with, like I said, every dollar we could put together, and then we worked in a consortium of loans from some of the folks you've met today. And that's been a couple pieces over the years, but it was a team of National Bank of Middlebury, Opportunities Credit Union in Burlington, and Addison County Economic Development Corp behind them. And so we put together 2 sets of loans kind of right off the bat in that first and second year, which helped us get to the point of actually opening our doors, starting to build up our inventory position, get into a real product, or even ordering things that, for us it's like ordering a truckload of glass bottles, right? Like, that takes a lot of cash, and it's hard to do those things. And we're fortunate to have a great space here in Middlebury where we can fit a truckload of bottles, but also we still need the cash to buy the bottles. So if you think of kind of every dollar personal money we've gotten together is number 1, and then the loans is number 2. Then a couple years in, we finally had a real product. We had released our gin, we were getting ready to release our whiskey, and that was when we first started going out to outside investors. And including then, and since then, we've now done 2 rounds of outside equity investment. Each one has taken way longer than we thought, and that included us thinking that we were being conservative. I even come from the industry, so I thought we were being as conservative as possible, and to the point I think I overheard Janice mention earlier, every round takes longer than you think. With all of them, it's scratching together, right? I mean, we've been fortunate to build up in each of those equity rounds a mix of outside investors that was regular, normal individual folks, what you think of as your classic angels, and a couple that were backed by either an institution or individuals who do invest for institutions but were investing personally. And so we've been lucky to scrounge it together and make it work. And I think a big part of that has been that it was a mix of different types of folks. We were successful at a good, pretty 50-50 split of Vermont money and outside of Vermont money. And we were good at doing a pretty 50-50 split of smaller checks and larger checks. In the context of investment, smaller checks means $25,000, where that's a lot of money to a normal person. But for, we've had folks from 25 all the way to 250, and in between. So we've tried to use diversity of investment as something to help as a strength, which has worked to date, but also it continues to always be frustrating, continues to always be a challenge as you keep raising, because you try to, in our case, you try to stay in growth mode. And one of the parts that I think has been a good part of the growth of the company has been that we've pretty much every year spent at the level that we wanted to be making the next year. It's a great way to keep growing, but it only works if you can fund the gap. And so it's great to see that revenue has grown every year, employees have grown every year. A lot of those have been really great success stories. But also you're always feeling at the point you're like, holy crap, if we don't pull a rabbit out of the hat again and again and again and again, how are we going to make payroll in 2 months? And those are very challenging parts that I'm sure you're all dealing with in various versions as you're trying to make a business grow and trying to feed enough fuel in the fire to keep going.
Yeah, thank you. Since all of you don't know what kombucha is, and I'm not surprised, I think I'll just start there. But kombucha is a fermented probiotic tea beverage made from organic sugar, green tea, and black tea. It's comparable a lot to yogurt or sourdough in a sense where there's a mother, so we continually use or reuse the yeast and bacteria which takes the nutrients of the sugar and the tea and converts it into amino acids, some B vitamins, and also that vinegar that if you've ever taste of kombucha, it has kind of a vinegary smell. And so what you're left with is very low sugar beverage, talking 5 or 6 grams per serving, where like a Coca-Cola would have 8 times as much of that. And we carbonate it and then add different, oftentimes local or beneficial fruits or spices to the beverage. And so at the end of the day, it's a refreshing probiotic beverage. It's similar to yogurt was maybe 30 years ago, where people think like, what is this? But today yogurt's in all shapes and forms, and it's in everyone's fridge. And it's also akin to kind of the microbrewery beer industry, what that was 10, 15 years ago. So we're seeing a lot of national kombucha brands, but if you go to any major city, or if you even think of Vermont with 600,000 people, there's 6 different kombucha companies in Vermont now. So every city kind of has their local brew as well. So on the financing side, yeah, Aqua by T's gone to, definitely spoken to all the lenders in this room, and currently have loans with the majority of them. When I came in as a second employee in Jeff's farmhouse brewing kombucha in the basement, he started in 2007, right? And I think it was probably 2008 when he got his first loan. So I remember he worked with Small Business Development Corporation. I know that was a great help for him, and we continued working with them. They had great models and advice. But I remember he had kind of like a binder that they helped him prepare for the business plan and projections. And I think the story goes, he brought the binder to National Bank in Middlebury, right? And they didn't know what kombucha was. And at the end of the day, he had a family member give $10,000 as a CD in the bank, so he was able to borrow $10,000 from the bank. And that's how like his baking relationship started with National Bank of Middlebury. Opportunities Credit Union probably came next to them in Addison County Economic Development Corporation. We're still working with them today, both working with Robin and now Fred. It's been great, and they're a great resource. What we love about them is that they're local, they have a lot of connections, they're always trying to help. They're small, right, so you don't have to go through a lot of levels. I can talk to Fred, and I can get a hold of Fred right away, and they're really quick on the turnaround. So we've seen that from, timing is a big thing. And while they can't lend up to, I forget what Fred said the limits were, but it's a smaller amount for a larger business like ourselves, but that is very helpful when they can tack on to another lender to get us where we need to be. And opportunities, we've had a few different loans from them. One was a line of credit. Again, they were really easy to work with. Greg Heisman had been there for years, and I think has since moved on. But it's up in Burlington. They hit that sweet spot for us where, like, we got a commercial loan. Then we went back to them maybe a year later and said, can we do a line of credit, which is really necessary for any consumer packaged goods business, because we know that we could order 1 pallet of glass and it would last us a couple weeks, but man, it would be nice if we could just pay for a few pallets and get a little bit of economies of scale. And so that's where a line of credit came in and was very helpful. And right at the beginning too, we started talking with Janice at Vermont Sustainable Jobs Fund, and that relationship was more of we weren't really looking for borrowing money from them at the time. It was more that there were grants and other opportunities where they wanted to help, kombucha and the sustainable jobs in Vermont and kind of building that landscape. And so they came to us, and we ended up doing a deal where we got some grants where the founder and another employee had a plane ticket paid for out to the West Coast, where they met with another kombucha brewer that was doing really well, and so we could just collaborate with them, and that was paid for through Vermont Sustainable Jobs Fund. So, like Janice said, she could be flexible, and that's certainly thinking more out of the box, where that really helped send us on a different trajectory. It wasn't borrowing money, so to speak, but we found out, what is this guy on the West Coast really doing? What does he see? And we could replicate that. So that saved just a ton of time and a ton of whether you're brewing in different tanks, or he's carbonating differently, or a different way to get glass or caps or a bottling line. Just learned a lot from those 2 days visiting out there. I think talking a little bit about ACCoC's move. So we moved out of Jeff's basement in 2011 and into Bristol Works. So it's like 800 square feet to 8,000 square feet in Bristol Works. And during that time, it was apparent that we were growing quickly and still needed to raise some money. And I left and went to law school around fall of 2011, and that's when Jeff and the team, I think there was 5 of us at the time, went into the first round of convertible notes. So he went out to, it was friends and family really, and in the form of convertible notes, and enabled the kombucha business to grow into and buy the assets that we needed, mostly vessels to brew in and some carbonating and bottling materials. And so we were in Bristol Works until 2015. And remember, that was about 8,000 square feet. And those convertible notes got us to about 2015. Well, in 2015, we decided we still wanted to grow, and Jeff's vision, he has a great vision and is, planning to, with a rocket ship. And so in 2015, we knew we needed to do more of a traditional equity round. And of course, equity is expensive. Have to give away a percentage of the company to be determined, right? And so we wanted to borrow as much from our lenders, from banks as possible. And so I was back from law school and involved in this equity round, but it was really an equity and debt round. So while we were trying to put together a package and speak to investors, we were also speaking to banks. And so we spoke to 3 different banks, more of the traditional banks, and there was a significant piece of equipment that we needed to get us to the next level. And it took a lot of explaining. At least the bankers knew a little bit more about what kombucha was, but this new piece of equipment was manufactured in Australia. There was only 1 or 2 around in the US, and
you had to teach me what it was.
Yeah, it took a lot. You needed it's called a spinning cone column, and essentially it removes the alcohol from kombucha, because kombucha could, when you're brewing it, get above the legal limit. And this removes alcohol from the kombucha without killing any of the probiotics at a very low temperature. Sounds expensive, it is. And in order for us to, so talking to the banks, we spoke to 3 banks, probably more than that, but got into the financials more with 3 of them and got a no from everyone. We went back to one of them and kind of took it from a different angle. She really worked with us and went to bat for us, and we got the loan done with that bank, along with an SBA loan, so 504 SBA loan through Granite State Capital. Yeah.
I think Jordan is touching on something I was hoping we would get a chance to talk to anyway, which is that when you talk to all the lenders on paper, they all are asking for the same thing, but the part that isn't often said, just the reality of how it works, is you end up needing to find the person that understands what you're doing, or the person that believes in you. That's the part that has been a unifying theme, I think, for all of us, because every one of us has some kind of business that to some person you talk to, they don't really get it, right? And so no matter, you want to say, hey, this is the business, here's what it is on paper, here I'll tell you about it, every lender should view it the same, but the actual practical reality is one's going to get it, one isn't, one for other circumstances that has nothing to do with you, it's just not going to fit with what they do. And so it really ends up being finding the people that understand what you're doing, whether it's because they understand the business itself or they just understand you. Those are the parts that end up being the tremendous assets. And there are people in this room I can speak to who, the kind of people you like working with, and that you end up either following them over time or continuing to work with them because they get it and they want to support them.
Yeah, thank you. I mean, it's really about building relationships. So you're here today meeting these people, and I've been with ACCoC for 10 years in total. And so, like I was saying, and I'll get to, but met Janice in the second year of ACCoC and created that relationship from the beginning. And it's come back to be helpful, and we ended up working with Vermont Flexible Capital Fund just last year. So it does come full circle, but it's telling people what kombucha is and then showing them your track record of what you've done. And it starts today if this is one of your first times coming to a conference like this. So that banker really went to bat for us, so we were able to get a commercial loan, and we brought the equity in. Sivan's right, I mean, you've heard it before, it always takes longer than you think, but you know, some of the first equity came in soon, and then it kind of stalled, and you know, you got to be optimistic in a startup company. So at the same time, you're like, well, maybe we don't need to raise as much equity as we thought we did because sales will just help out, and that's what we're hoping for, you know.
Constantly flying by the seat of your teeth.
Right. We can just get by with this cash flow, then we don't have to, you know, raise more equity, hence give away a little bit more of the company. So that was in 2015, 2016 when we closed the loan. Equity came in, and we moved to the old Vermont hard cider facility. We started co-packing. We shared the facility with them. So we went right from 8,000 square feet to 63,000 square feet. So we didn't take over the whole building all at once. For our spinning cone column, we needed a facility that Bristol Works couldn't handle. It was great to work with Vermont Hard Cider. They've been around for years to learn their system, so they're really kind of like our mentors in some ways. We're trying to take the good things of what they're doing operationally, the systems that they were using. How do you determine how many gallons you're producing today and what flavors? And it's just we're always learning, you know. So we learned a lot from them, and we started sharing the building with them. And then in May 2017, we took over the building. So they were renting the building, and so we took over their lease. And again, that wasn't so much on the financing side of things, although, you know, we had to build some pretty sophisticated models of understanding what would it look like for Aqua IT to take over the building, and what sort of cash flow would we need? Would we need other tenants, or how much would we need to grow ourselves in order to do that? And of course, you know, I don't remember the specifics, but we're still working with banks. We're still raising money. I know that again in 2017 we started another round of convertible notes, and that was purposefully to bridge us to a gap of a much larger equity round, which as of today has not happened yet. We're working towards it, but that started a new round of convertible notes in 2016, 2017, and that's so. As Sivan said, we're in the business, the startup business that's trying to focus on our product and the quality of it and continue to grow. But it's just, you know, a fact of most businesses that you always have to be looking for money as well. And how far will that money get you? And will your sales numbers hit where you need to so you don't have to borrow as much as you think? That's kind of the. I know there's probably a lot of questions, and we're going to open it up in a few minutes, but that's kind of the summary of Aqua IT's financials. I just add the most recent round is we finally purchased an automated bottling line, which we've been thinking about for years, right? We've been 10 years in the business now, and last year we purchased an automated bottling line, which is great. It's doing 4 times as many cases per hour with a lot less people, something that our competitors have had in place for many years. And you know, it's hard to believe if you went back to see what Aqua IT, how much we were producing per day, per week, and selling, and literally people were there hand filling bottles. It was just a lever that you put the bottle in, pull it down, pick it up, put the cap on. And we were doing that up until about a year ago. And it came full circle because we worked with Janice at Flex Fund to kind of fill that necessary financing gap where we didn't want to raise more equity at the time. We had already done some convertible notes and didn't want to necessarily go back to the same investors again for an automated bottling line. Janice came in and worked with us, and it took a few months. Not partly that was due to us of finding the right line that we wanted. You know, manufactured in Italy took many months just to land that deal. But Janice came in for the majority of the amount, and Fred with ACEDC came in again and added on another 100,000 so that we could get the bottling line in, and that's been up and running since the fall of 2018. I believe that, along with our convertible notes, is the last financing that we've been looking at, that we've been doing until our next equity round, which we expect in the next 6 months.
So, a couple
Jordan,
tidbits.
can I ask a question? Just in case there's some people in the audience that don't know what they are, can you explain what a convertible note is and how they work?
Yes, what we've used for convertible notes is, I'd say probably most of the traditional is a note that is accruing interest that will convert at a specified trigger. So the trigger could be, ours is, for example, a qualified equity round, and that qualified equity round has a definition of a certain amount of equity raised at a later date. And so the kind of levers that you can pull or change around on a convertible note is, what's the maturity, is there an interest rate, and what discount, if any, will that convertible note convert into the next round of equity. So if somebody's giving me money in the form of a note now, they're taking on a greater risk. So I'm going to give them a discount into what will be what we want to have as an equity round later. And so the discount, I think, is typical, again, 20 to 25% is what I hear. And so that's what has done in the past, is raising money through convertible notes. If there is not a qualified event, so if those don't convert into the equity round, then it's just like a loan where the interest rate, there's a maturity date on our notes, and we'll pay that back in a few years. Does that make sense? It's closer to me. If it's completely new to you guys, it probably
I can
sounds
say it another way.
straightforward.
So convertible notes are a hybrid between debt and equity. And, on their face, and as they start, they're debt. But people who are backing you in this debt have an opportunity to become equity later if things go well. All the details can be spelled out in a million different ways, but it's a chance for the folks who are believing in you who are, they're a little more equity-like than normal debt, but they're a lot more debt-like than normal equity. I see a hand from Mike, yeah.
I know we're not open for questions yet, but I had, along the similar lines, I wondered if you could both, before you get too far down the life of your companies, talk about the importance of understanding equity if you're going to raise it, and who you go to help you set up these documents, and if you have to worry about the SEC, and if you...
Sure. So it's a great springboard for actually where I was going to go next before we open questions. So, I think something that doesn't get talked a lot about is that not every small business is a startup, and not every startup is a small business, and that's okay. I think a lot of the talk that goes around just treats all these things as the same thing, and that's just not always the case. And so I think it's unfair to lump folks in all into this one big pot, because there are so many different types of financing that can happen, and any business could use any of these, but you'll end up finding that some things fit your business a lot more than others. And so, for example, a lot of small businesses, just take a classic Main Street business, right? Like, those aren't businesses that in a small, if you're a bookshop or, a classic, like old school Main Street business, you're not necessarily in that location trying to grow to 100 employees or to bazillion dollars of revenue. Maybe you want to eventually open other locations, but those are different types of businesses than a business that's trying to be a manufacturer and is trying to, add new equipment. And so you end up seeing that it's totally fine for those different types of businesses to take on different types of financial backing, right? A lot of things don't make sense for equity, and they only make sense for debt, or vice versa. One thing that you'll run into that I think is serially frustrating for any business owner is that the earlier stage your business, the weirder and riskier it is, the more a banker, when you talk about loans, is going to tell you, maybe you should get some equity money first. But in the modern world, it's really debt that helps you do those first parts before you can prove a concept and then maybe actually be able to raise equity. So it becomes a really frustrating chicken and the egg solution. And Jordan touched on some of the things that end up being the solutions, right? Jeff's family member putting a CD at the bank that the bank can hold as collateral so Jeff can actually borrow. Like, all those things, they happen, right? Like, our lenders still have a second lien on my house. That is frustrating, right? Like, those things, those are parts of, but it's part of the blood, sweat, and tears we all put into these things to try to grow our babies. So a little bit to Mike's question, the people who help walk you through what you end up doing will end up being the ones that can help you answer some of these questions, right? Your lender, if they're good, will help walk you through what you need to know about the loan. If you're raising an equity round, you're never going to be doing that on yourself, on your own. You're going to have some, at the very least, your lawyer who's helping you do stuff. It may be someone much larger or a fund who's helping lead it. Those folks will help you think through those things. The biggest part to know off the bat is A, trust your advisors, your lawyer or whoever else, and B, don't go out trying to raise equity money until you have a proper advisor to help you, because it can totally be nice and easy with the right person helping you write your docs for you and tell you, yep, as long as you make sure you hit this, that, and that, you don't have to worry about filing this to the SEC and that. But if you just go do it yourself, if you go start and doing some of the things that you wouldn't know are just not okay with the rules. You can't go advertising an equity round to anyone and everyone. That would be a violation of the law. You don't want to do those things accidentally. That's why it's helpful to have either your lenders helping you through loan docs or a lawyer helping you through equity docs. A lot of these things sound really complex, and they can be, but with the right folks helping you, use the experts for what they are, right? Because we're all trying to do our actual businesses, not trying to get smart about something else. Let's take that and open questions. Sure.
So, I was wondering regarding equity financing, how does that affect your companies, respective companies, politically and or from a management reporting status?
Sure. Yeah, there's some parts that are kind of standard, and some parts that it depends on what you and your investors end up kind of agreeing on. Standard is always going to be, look, they have some kind of information rights. You got to tell them how the business is doing. Sure. You have to provide them financials. Whether you're formally required to, whether you just choose to do it, you should be giving them a formal update at least once a year, and probably informal updates every quarter. It tends to be that your investors deserve to know as much as they want to know, right? That's not a formal rule. That's just a good rule of thumb, right? In the sense that some are going to ask you a lot more questions than others. Some are going to want to know more, and they have the right to know as much as they want to know. You can always deal with non-disclosure agreements or confidentiality agreements if you're worried that there's certain trade secrets that you can share with them because they back you and to make sure they don't share with others. Management rights is a little bit different, right? Like, how much of a voice do they have in what the company does? And I don't think the world is as black and white as the founder should want to keep every right himself and never have any input, and the investors should want to have input on everything, right? I think the actual world is much more between those. But the standard way it usually is when you get to the point that you're taking on investors, your company's operating agreement or whatever other document establishes what the company is and how it works, depending on what type of entity you are, something that your lawyer would end up writing, will say, this list of things requires approval from either the members, or maybe you have a board and you create a board that from the investors. This list of things requires approval, or this list of things requires approval with 51%, and this list of things requires approval with 80%, right? And anything that isn't on the list is in the purview of management to do what you think is appropriate for the business. So usually the best practice is to spell out who's involved in what, so that everyone has on paper. It never matters when it's clean, but you need to have it set up while it's clean so that when it does matter, if things go south and get messy, that's when things were very clear. Now, here's what we need approvals for, here's what we don't. For example, in Stonecutter's operating agreement, it spells out that any budget decision over a certain dollar amount requires approval. Okay, now you know that we can go out and buy a truckload of glass because it's way under that threshold, but if we're gonna do a major renovation, we're doing a major renovation right now and putting equipment in, right? That was above the threshold, that required approval, right? So you start spelling out what are the kinds of things we're gonna go to, and I think the cleaner you can be, it's always better than one.
Yeah, I would just add, it's same with ours, it's in the operating agreement, which every time we do a round of financing or more convertible notes is updated, but within that document spells out what the current board of managers can do without investor approval. And so just having a good attorney and a close relationship with them Every time that you're raising money or taking on debt, it's good to keep your attorney updated with what you're doing. But all the details can be found, say, in our operating agreement, and before we, issue more convertible debt, and when we're doing an equity round, that operating agreement has to be shared with the investors before they sign off or before they invest money with us. I would just add, at some point, or raising enough money, or if you need money bad enough, depending on your situation, that money is going to come with more strings. So if it's just a little bit, and that investor trusts you and wants to just sit back and see and let you take off, that's great. But if you're saying, I want to grow at 100% year over year for the next 2 years, and the investor says, great, I want you to as well, here's $2 million, and by the way, I want to make some of the more finer details on the decision, and I want to be able to approve the budget, and I want to, be involved in hiring who the chief marketing officer is. That will just happen in the negotiations as you're raising money. But I'd say the more skin in the game that the investors have, the more kind of control or insight they want into the business, until it gets to, as I said, board seats on the board and decision making.
And a part that Jordan touches on indirectly is that the better your plan, the better it's worked out and fleshed out, the more you can communicate it, whether we're talking about equity or debt, the better your relationship is going to be with all of the folks who are backing you, right? Like, if you go into a lender and say, I want to borrow money so I can grow my business, and they say, great, what's the money for? And you're like, to grow the business. That's not an answer, right? But if you go with a plan, and here's what I'm trying to do for the business, and here's what all the pieces cost, and what the budget is for the next months or years, and because of that, therefore I've worked out, here's the amount of money I need, that's a framework to start from, right? Whether it's lenders or equity investors. So good communication, it ends up being the salve of many of these things, right? Like, sure, we have lots of things spelled out what we do or don't need approval for, or this or that, but if it ever gets to the point that you're haggling over those parts, you've already gotten way too far, and, into the quagmire. And if you can just, whoever is either going to invest in you or already has, or your lenders, to the extent that you can just have an open dialogue and try to be sharing, here's what's going on, here's the problems we hit, here's what happened, yeah, we didn't foresee this coming, it's putting a strain on the business, but here's what it is, here's the plan of how we're addressing it. That's going to give them a lot more comfort than if you never talk to them until the last minute. Carl?
So how much time do each of you, and I understand that both of you have somewhat of a luxury of having companies that have, in your case, Sivan, you, and maybe Jordan, in your case, you, and others, that can devote themselves to actually figuring out the financing piece. Estimate how much time you're spending on that, or your company's spending on that.
Yeah, I would say, unfortunately, it's a major part of my time. I wish it wasn't, because you do all this work just so you can then go do the actual work of whatever your company does. It's not that easy. No, it's not. Right now, we're raising a round right now, and the rounds take time, and it's the kind of things where you drop everything when someone's ready for something. And I drove up to Burlington this morning before this to pick up a check from an investor who was ready to write us a check. And then I drove down here to come talk, right? And it's like, those are the things you do, and it does take a lot of time. It also takes a lot of time flexibility, right? Like, a couple weeks ago, I got an email from a potential investor we're trying to work with Friday night as I was getting ready to go to bed. It says, sure, why don't we talk tomorrow morning at 9:30? It's like, okay, I guess I know my Saturday morning plan. I was going to go skiing, but I'm switching that up, and I'll change the plan a bit, right? So it's not just the amount of time, it's also how prevalent it can be. And the other part is, it's sad but true that once you start raising, you kind of never stop. Not for the bad reasons, for the good reasons, but once you get into growth mode and you start seeing the things that outside help can help you grow into, that usually has a positive cascading effect. You start seeing other opportunities of what you could grow into as well. But it does mean that you always want to say, yeah, we'll finish this round and then we'll get back to actual work, and then a couple years later maybe we'll do a round, and then, but sadly it ends up just being concurrent with everything you do.
Yeah, I mean, Sivan's not alone with feeling frustrated, I think, and I think that's typical for a lot of companies that are growing quickly. When we both look at how much time we spend raising money. Again, we're not, that's time that we're not focusing on the product itself or the leadership team or, you know, bringing on and interviewing new people that are going to help really grow the company and add value. Raising money does add value, but it's to the end of the product itself. And so, yeah, it's frustrating spending all the time doing it versus, you know, working on the product. But it's a necessary evil, I was going to say, but it's necessary. And I mean, why do we do it as well? I mean, part of it, we could say, we could decide as a company, hey, we've got this figured out. We're going to raise $4 million today, and we're going to have a good runway where we can actually work on the business for the next 2 years. That's our projection. But if we said we wanted to raise all $4 million right now today, that might mean we'd have to give up too much. So we're not willing to give up that much. So let's just eke by, or how much do we have to raise so that we don't have to raise any more and give away any more equity. And so that's why you end up in this cycle of we raised enough to get us through the next few months, and we hope that the sales are going to be where they are, and we won't have to go back to the investors. But if we do, we've done it before. And so I don't know if that's similar to you, but it's you know, you don't want to, well, do you raise enough money and give away some of the company now so that you don't have to raise again? And that's just a decision for the company and the owners to make, you know. But that's I think why a lot of us and you'll hear from other people that are running businesses is you're always looking for money, because most aren't willing to give away that much equity that it takes so that you don't have to think about money in that way for a year or 2 years.
And before we commiserate too much, because we should probably do that after work at a bar or something, it doesn't necessarily get easier, but it does get more familiar. And that is the part that, especially when you're doing this for the first time, you go, I don't even know what these words are. It's an alphabet soup of things. How do I even speak to this? And the more you've done it and the longer you've done it, the more familiar it is, to the point that you can start having these conversations off the cuff. And you can meet someone in a random place and you realize, oh, this is actually a person I should talk to about X, Y, or Z. And you can get into what would have been a conversation that 2 years earlier you would have not even understood your own words. So that part at least gets better.
Yeah, I mean, I think that's an overall great theme here. It's like continually learning. So it may sound like we've been doing this for a while. We know a lot about financing, but I'm still learning a lot. And when I talk to, we're talking to some venture capital firms now, they're throwing out terms that I don't know about. And, at the risk of sounding ignorant, you have to say, what did you mean by that acronym? Or, what type of treasury services are you talking about? And, I was just talking to a large international bank the other day, and they were, pitching us on treasury services and how it can really help with foreign exchange. And, I had to put it on mute and be like, oh yeah, because our foreign exchange, that's what we're worried about. And, we're not there yet, but you gotta learn to where you get to. So I'm continuing to learn every day.
So at this point, how much equity have both companies given up, and where do you see yourselves at a point where you're just going to need operational funds and not investment funds?
Sure. Yeah. So for Stonecutter, we started two of us, and so the two of us started with 50-50 of the business, right? And at this point, we've given away about a third of the company, which, honestly, sure, you want to keep as much as you can, but I think that's totally reasonable for how much our outside backers have helped us be able to grow the company. The second part of your question is a harder one to answer, because even at the point that you grow enough to be profitable, oftentimes your businesses still need more capital than you're making to keep investing in yourself, right? In our case, we make gin and whiskey, and if you're accurately projecting whiskey and whiskey growth, right, we have to put down, all of our whiskey is 4 years plus, so we have to put down the next 5+ years of whiskey in barrels at any given point, right? So I'm always putting down 5 years from now's whiskey, because we already have 4 years, 3 years, 2 years, 1 year from now sitting aging, right? And if you think you're going to grow every year, well, I have to put down much more for year 5 than I would need for this year, because year 2 is going to be more than year 1, and year 3 is going to be more than year 2. So some of that, we might be profitable with what our costs and what our expenses and what our revenue is this year, and still need to be raising money just to be investing in that part. And not that every business is like ours, but you would have lots of cases where it's like, hey, we're growing, we're doing well, but we want to invest in this equipment or this extra new whatever, and you could be profitable and still need to be raising money to bridge those gaps.
Thank you.
So we had our first convertible notes were issued in 2011 and 2012, and those notes, while there wasn't a trigger, their trigger was at maturity, they could choose to convert. And from 2011 to, I think it was, the end of 2017, Apple IT had grown a lot, and it was a no-brainer for them to convert at the agreed-upon price per unit or per share of the company. So all of those notes converted into equity, and that was kind of the first time that the company had given away equity in 2017. Well, I say we had a simultaneous raise while at the same time those notes converted. It gets interesting where, like, how much equity have you given away versus how much control, because within your operating agreement you can have different classes of shares, which we have, and different voting rights for those shares. So while the original founder has less than the majority of units owned, control is still maintained by the owner, not Apple IT, because of the way that we're structured. Was there a second part to that question?
Well, so put another way, you guys have sold off at least about half of the equity of the company, but you have maintained more than 50% control.
Right, so it's understanding the nuances of each company's operating agreement, and control is a big part of the game at the end of the day. So, next.
The other part of the question is, at what point do you see just funding for operations or,
Right.
Versus still growth?
Right, that's that. So looking at the kombucha category, and who we compete with, we're in the top 7 for the kombucha companies throughout the U.S. We're probably the 7th largest. 5 of those 7 one's private and have been around since the beginning. One was purchased by Pepsi. All the others have done some major rounds of equity, which we would consider we have not done a major round of equity. So we're on that trajectory, so it's hard to answer your question directly. We see that what we may call a Series A that we're looking to do in the next 6 months, it's very likely if we want to remain on the same trajectory as the other kombucha companies and grow where this category where we think it can go, and the capacity that we have in our facility, we'd probably have another equity round after that and maybe another one. And not that we're gunning for an IPO, but that is also a possibility when we're on that track.
Thank you.
Can you guys talk about your conversations with investors around return and exit?
Sure. Yeah, I think honesty is always the best policy, because if you start trying to tell someone what you think they want to hear, but it's not true, you've already ruined the relationship. So I think it ends up having to be soul searching first of what is your actual plan, then make sure that the people who are backing you back that plan. It's okay to say, I want to build something that's going to be huge and we're going to sell it and I don't want to have anything to do with it and I'm going to go retire on a beach if that's the plan. It's also okay to say, hell no, I will never let someone take over my baby, and that's okay too, but whatever is the right answer for you is the one you have to be telling folks, so that's what they're backing. And in the end, obviously the real answers become more nuanced, right? It's starting to talk to your investors about, this is the range of things we're comfortable with, and these are the things that we're not, like, if this is the whole continuum of things, we like this chunk. Anything in there, 5-10 years from now we're happy with, but we don't like that, we don't like this. And I think to the extent that you can talk about those openly and honestly, that's the folks you want writing the check in the first place. Because if you want to do something in this range, and the people who are backing you are really gunning for something over here, then 5 years from now, you're going to have some really ugly confrontation with your investors, and that's not healthy for anyone.
Yes, starting with honesty for sure. I mean, I remember the meeting sitting with Jeff, the owner, and bankers want to know. That's a valid question that should be asked, because when you have a solid answer, I want to grow this company and sell it in 3 years. Like, if you know that, then that's a great answer, and you have a goal that you're striving towards. And
As long as it's reasonable.
yeah, it's something to be said to have that goal. But I think more often than not, and what I've heard from our company is like, we were definitely didn't have the answer then, and we still have debates about how far we want to take it or what the vision is, because there's still so many opportunities. So we probably fall in the category of, sure, in the first 2 years of the company, it would be like, I don't know what the exit is going to be. You know, what should my exit be? And now it's, yeah, we see a few more options, and we're fine tuning it, but we're not sure yet. You know, and that's still our answer today. Yeah.
Any other questions?
Just one short answer probably. When we talk about giving up equity or ownership, does that equate directly to profit?
Usually, to Jordan's earlier point, there can be multiple classes of shares. Folks who invest in this get this, and folks who invest in that. But assuming that you're not getting complicated, it usually does. Yeah, and whether that is actual profit that's being distributed, or is it staying in a company,
Right.
is a separate question, right? You know, you could be a company that's profitable and making money, but keeping that money in the business and plowing it into new things you're trying to grow in. But yeah, if someone owns 20% of your company, they have a claim on 20% of your profits, one way or the other. If you're investing it back in the company, okay, you're making the company worth more, and their 20% is becoming worth more from that. Or if you're actually distributing money to yourself, you're probably distributing money to them too. The exceptions would be if you're talking about, you know, does the owner draw a salary, things like that. In some businesses, yes. Some businesses, no. You just, if the business is profitable, you get some money because of that. And whatever that is should just be something that you're open and disclosing with your investors. It's okay for a company where the owner draws a salary, right? You're working. You're the operating partner, and the investors are more closer to what you think of as silent partners, right? But if you tell folks, hey, I'm going to raise a couple $1 million, I'm going to pay myself $400 to $1,000 a year, they're probably going to tell you to F off, right? So everything within reason, better to know what it is and to talk about it.
Great answer, thanks.
Yeah, I don't have anything to add on that. I think we're wrapping up, but I would just say some advice that I've seen that, you know, the owner and I've continued to follow is, you know, find one or two or more mentors, or what you might call business coaches, that are close by you the whole time and advising you on all of your options, because all of the lenders that are here today, they're great people and they'll lead you in the right direction, but if you only talk to them once, they see your business plan, and then you don't talk to them again in 3 or 4 months, you know, things have changed in your business, but they're not always going to know the nuances of your business. But if you can have a business mentor, ideally they're free, but even they're, you know, you could pay for that consultant or coach or whatever you want to call it. But it's really helpful to help you think about what your exit plan is and what your options are, because someone that's done it before and has experience just is very valuable to help you grow your company and not make too many mistakes. Mistakes are going to happen. You can learn from them. That's great. But some easy ones, yeah, you know, all you have to do is have a mentor or talk to the right person. It's valuable.
And don't be afraid to ask people for that help, right? Like, you'd be amazed at how many people are happy to get dinner with you because you said, hey, let me buy you dinner once a month, or let me buy you a beer once a month. And, you know, to actually be open about, maybe we're also socially friends, but I actually want to try to meet with you somewhat regularly just to pick your brain or to update you in things and see what jumps out at you. A lot of people are happy to help without necessarily being paid coaches, and there's also actually paid coaches who professionally do this stuff.
Yeah. Any other questions? Thank you, gentlemen. Really appreciate it.
Thank you.
So this is where I take a minute for a shameless plug, especially since lunch isn't here yet. Sue, I'm having event anxiety. Yes. So I just want to point out in your packet a couple of things that I put in there. One is a list of our workshops that we're doing this year. Oh, good, here she comes. Just point out a couple of them. At first, I'll point out that this schedule is subject to change, so the best thing to do is keep track on our website. There's an event page on our website, and not only do we put our events on there, but other events in the community, other events of interest to members and businesses, so log on often. But the ones coming up that I want to point out are in March, we're doing an Optimizing QuickBooks class. This is a full class on how to optimize your QuickBooks to get what you want to get out of your financial reporting. That'll be taught by our own Elizabeth Burdine, our finance director at ACEDC at our shop down on Route 7. Then in April, we're doing first hires for young businesses that are thinking about adding employees for the first time. So if you or any businesses you know, your clients are looking to take that leap, I recommend that they come to that class. And then in May, we're doing our annual ownership succession class. That's a partnership with the Chamber and with the Vermont Employee Ownership Center. But the class will not just focus on the succession plan being employee ownership. That'll be part of it. It'll cover the whole gamut of how to do ownership succession. There was talk today about, how do you plan your exit? Well, this will help with that. And then the last one, you heard some mention of the alphabet soup, not only in financing, but just in all the programs that are out there. We partner with a lot of organizations, the state and the feds, and they all use acronyms. And there's lots of programs that you may not know about just because the first thing you got to learn is the damn acronym. So we're just going to do a day like today, similar to today, but it's going to be about those programs and services that are available to you that aren't financing. They may have financing elements to them, but they're the other things. They're the Small Business Development Center, the Vermont Manufacturing Extension Center, grants that are available, believe it or not, for businesses. There are very few, but there are a couple, like from BGS, the Vermont Buildings, Grounds, and Services. Believe it or not, they have big grants for businesses, and you apply through us to get those. So we'll tell you about those. But all kinds of programs and resources that are available. We'll cover those in June. The other paper is about the services we offer, and just consider membership. Consider membership with us when you're ready, and at the right stage of business. Consider membership with the Chamber. Lots of resources there that become available to you beyond what we offer to the community. And like today, both our memberships got free admission to this workshop, so that type of thing. All right, so it looks like lunch is here, so we're going to break and grab your lunch. Go back to your seat, and there's drinks in front of the things there. There's water, and there's some iced teas. There's still coffee and tea. And we'll get Aaron set up and do his presentation.
Is everybody ready? You want to start? When Sivan and Jordan were like that classic position of, hey, we're the last speakers, separating you from lunch. That's always a difficult position. If there was a speaker after lunch, you're always in that difficult position of people staying awake. And my job is not to give you indigestion while you're eating lunch. That's what I hope anyway. But we'll see. We'll see what happens. So I'm Colin, and I am I'm the co-founder and one of the managing directors of Press Tracks Capital. So if you don't know us or who we are, we're a venture capital firm primarily focused on Vermont, but not exclusively on Vermont. We've been in business this is year 19. We have had 4 different funds. They total about $48 million. We've made 48 investments over those 19 years. I also am I teach a finance class at UVM. Laura, you can tell them whether I'm good or not. You took that class, so I don't want to put you on the spot.
He's the best.
Oh, yeah, okay, good. We'll get the beer afterwards. And I also instruct the SBA Emerging Leaders class. We're going to do that again this year. I think Kevin's here, right? So if anybody doesn't know about that program, it's free. One of the few things you can get really for free, 15-week class. I help facilitate that. So talk to the SBA, they're recruiting. And I help with a farm and food acceleration program called Wind and Grows. We're about to start a fourth cohort there. So that's my brief commercial introduction so you know who I am. So I have these fun little rules of raising capital that are just kind of my experience over the years of what I've watched folks go through. And I always start with the golden rule. And I ask everybody, you all know what the golden rule is, right? Somebody want to tell me what the golden rule is?
$2 how you want to be treated.
Yeah, no, that's not it. Here's what it is. It is,
He who has the gold makes the rules.
yes, if you've got the gold, you make the rules. And we're going to talk about the capital stack today. And we're going to talk about how there's different layers in that capital stack. Think, I don't know, waffles or pancakes in a giant stack. Every one of those layers is gold, right? There's money, and every one of them has their own set of rules, right? So there's the golden rule. Second rule, from my perspective, is, and it may seem counterintuitive, but the best time to raise capital is when you don't need it. And so the worst thing for most capital providers is to get a call on a Wednesday saying, I can't make payroll on Friday, and I need a loan, or I need an angel investor, or whatever it might be. By Friday, the answer is generally always no in that case. Third rule is right-size your capital raise. You need enough money to get whatever it is you're trying to do done for that time period. You need that amount of money and not a lot more and not a lot less. And I'm sure you've all heard stories of folks that say, well, and Joe talked a little bit about it today, we kind of need $4 million, but we don't really want the $4 million today. And let's see if we can figure out a way to make do with something less. So you get forced into that position. My recommendation is know what you want and raise what you want, rather than shoot for the moon and shrink to something different and say, well, I can make do with that. Raising capital, no matter whether it's debt or whether it's equity, is the first step to losing control of your company. There's no way around it. People somehow don't think that's true with debt. I've seen more companies forced out of business by the debt providers who exert a lot of influence, and they have collateral. They essentially have control of your company, whether you know it or not, if you start missing payments. So if you don't want to lose control of your company, there's one really simple rule: do not take a dollar from anybody else. If you take a dollar from anybody else, you are starting down that path, and you have to learn to live with that uncertainty. No way around that. Next rule, if you borrow money, it's supposed to be repaid. Sometimes people forget about this. And then the other corollary rule to that is if you take money from investors, you have to think of some way to get them their money back and whatever return expectation there is. Those seem self-evident, but it's amazing how many entrepreneurs sometimes kind of forget that money comes with those expectations in some fashion. If that money comes from your family, remember there's a holiday in the U.S. called Thanksgiving, and everybody gets together and argues with each other and watches football and eats too much and all that. If you have taken money from Aunt Mildred or Uncle Harry, I guarantee at Thanksgiving there will be a conversation about how things are going. And so you need to understand that that's a string that's going to be attached to that. And then my belief from a lot of years of doing this is that loans are a little more transactional, but equity is always a relationship. So I'll say that again. Loans are more transactional in nature, but equity is always a relationship. And you've got to kind of think about it that way. All right, so when we talk about the capital stack, what am I talking about? I've thrown almost everything in the kitchen sink up here. And if you remember a balance sheet from your accounting statement, this is kind of looking down the liability side of the balance sheet and down into the equity section of the balance sheet. So you have, in the capital stack, you can have senior debt, that's usually a bank, credit union, somebody sitting at the top of that stack. That, and when I say senior debt, I mean they're the first ones to get paid. They typically have the first claim on the assets of the company. So senior debt, you can have junior debt, and junior debt is subordinate usually to the bank, and that can be from an alternative lender in some fashion. I mean, ACEDC, I'm sure, does some subordinate lending where they're in second position and so forth. You can have hybrids of debt and equity, so a mezzanine debt is an example of that, or what's called venture debt sometimes. And it's both a loan, but it also has some sort of a warrant, and a warrant is a claim, a future claim on some shares of stock of the company, so it's so-called equity carrier. So it's both debt and equity. These guys cover convertible debt well enough that I don't need to cover it, but convertible debt, the way I think about it, is really equity. Yes, sometimes you can repay it in some other fashion. In general, if you sell convertible debt, it will likely convert, and you will likely give up equity by doing that. So I think of it as an equity instrument. And then there are different stacks of equity. So there's preferred equity, which usually is the outside investors coming in and sitting above the common stock, which is usually you all, the founders of the company. And there can be different series or classes of preferred stock, Series A, Series B, Series C, Series D. And each of those can have different elements to them as part of that stack. If you give away options to, or restricted stock, or stock appreciation rights, which aren't really stock, but kind of act like it. If you do those kinds of things for your employees, that's another piece of the capital stack. And then there are the, what I call contractual liability obligations, which aren't necessarily always considered to be part of the capital. So that could be royalty finance, could be what's called a SAFE, or a simple agreement for future equity. It could be a factoring deal. So the garment trade used to run on factoring, where companies would literally sell their accounts receivable to a factor at a discount, and the factor would collect those accounts receivable. That's an off-balance sheet sort of a transaction when that happens. But each one of these pieces of the, oh, wait a minute, there's also a couple of other things I didn't put up here because I didn't want to make it really complicated. New market tax credits would be one. And another one, in today's world, because everybody's all whipped up about it, but I think it's actually not going to use much of anything. It's going to be a lot of sound and fury signifying nothing, and that's opportunity zones, right? So when you get all of this put in there, you've got a giant capital stack. And each one of these pieces of the stack, each one of those pancakes, if you will, has economic rights and governance or control rights. Each one of them does. So in an example of a senior debt deal, the economic provisions would be things like what's the interest rate and what's the repayment terms. And the control provisions would be they have a first lien on your business assets. They have, there's negative covenants and affirmative covenants that you might have to meet in the operation of your business, or they can declare a technical default and move to fully collect the loan. So that would be an example of economic and control at the top of the stack. At the bottom, at the bottom of the stack, your preferred stockholders might have the right to appoint members to a board of directors and to approve certain decisions that the company might make. And I think, Sivan, that you mentioned some of those in your case, so that we don't need to kind of double count those. Okay, so I now have 5. I'm going to break this into 5, basically 5 sound bites, what I call the dynamics, really. And principle number 1 is, it's your job as the entrepreneur to manage this capital stack. It's not your lawyer's job. It's not your accountant's job. It's actually not your advisor's job if you hire or have a mentor. it's your job to manage this capital stack. And so that means it's going to take a certain amount of knowledge on your part that you're going to have to gain. And it's going to take a certain amount of time and effort. So you put into both learn how to do this, but also the ongoing operations of the It's important to build the stack thoughtfully, and that each of those components are going to have to relate to each other within the stack. Your lenders may want certain things to happen that might be at odds with your equity providers. You may have different types of lenders that have different ideas of what you should do and how their covenant should work. And so you can have this issue with interoperability of all of those different capital providers in there. So you have to kind of thoughtfully construct that and understand how they get along in the sandbox that is your capital stack. You're going to have to report to your capital stack transparently and frequently. And the more layers you have in the stack, the more different types of reporting that you might do. So if you have a senior bank loan, you may need to be providing the bank with monthly financial statements and some maybe monthly analysis on how that is various to projections. For your equity investors, you might need to have quarterly board meetings and a quarterly package going to them. And they may want some sort of an annual meeting of stockholders where they can really get in front of you, query you, and so forth. So there are going to be each one of those layers that you put in there does not necessarily mean, oh, I can just duplicate the reporting I'm doing to somebody else. So therefore, the more layers, the more complexity. Third bullet point, Vermont's a small state. If there is a hiccup in your capital stack, everyone else in that capital stack is going to know about it. Right? So when your bank suddenly decides they don't want to renew your line of credit, that's going to trigger everyone else figuring out what's going on, and then the drain, you start to have the swirl around the drain sort of in that case. So it's important that that everyone in that stack know each other, but it's also important that you keep all that stack up to date and that you realize that you can't tell one member of the stack one thing and another member of the stack something else. They will figure this out over time. And the last thing, which should be obvious, but again, I'm going to hit on it because sometimes people don't understand it. Other than those few grants that Fred mentioned that maybe are out there, money's not free. All money comes with some sort of constraint to it and some sort of economics and control, as I mentioned before. Principle number 2, the capital stack is not linear. So although you would think with Janice's capital continuum and some of the other discussions here, it was interesting to hear your viewpoint on this, Sivan, because what you said dovetails nicely into this. You would think that at one end of the spectrum is low risk, low reward, and at the other end of the spectrum for the capital providers is high risk and high reward, and you would think that you would first go to the folks that are high risk in nature because you're a startup or a young company, and you would eventually progress along this stack and end up eventually, when your business is really up and running and doing well, with the lowest risk and lowest return kind of senior debt providers. The reality is that you can, with a really good plan and a really good team, probably go out and get you tell me if I'm wrong here, Kevin, but the 7A program will actually, if you've got the right team, the right projections, you might be able to finance a very young company with debt. So you don't necessarily have to go to your friends and family first. You don't necessarily have to go to angel investors. You may find yourself with a 7A loan to begin with. Down the road, you suddenly need some more money to grow a little more quickly, and all of a sudden now you might be out raising equity. And the lender or the equity investors might look and go, boy, we don't really like the terms of that 7A loan. That's a problem for whatever reason, right? And so forth and so on. So the capital stack is not linear. You're approaching multiple sources all at the same time, and it's your job to figure all this out. And it's chaos by design. So every single year I hear from sorry about this, Fred, but economic development professionals and governmental officials and everything who want to figure out a way to organize the capital stack so that entrepreneurs have one easy entry point to some unified application. That's not the way it's designed on purpose, honestly. Chaos is actually your friend. Learn how to manage that chaos, because you don't want one hierarchical thing where you've got to go to one entry point and then hierarchically get sorted as to who's going to take you, because that's bureaucratic and it will not work. So there's no correct order at the time. You can go out and talk to anybody and everybody all at once. Dynamic number 3. It will always take you longer to raise money than you think. And as these guys pointed out when they talked about their case study, you may find that once you start raising capital, you're going to continue to spend a considerable amount of time raising capital on a continuous fashion forever. There are few companies of any scale in Vermont that have any sort of a stable plan where they don't need some sort of capital support, whether it's an ongoing bank seasonal line of credit, whether it's some growth equity to take them from $10 million to $50 million. Almost every business needs some sort of ongoing capital. So this is just, you're going to be in business, you're going to take outside capital, get good at it. There's got to be a core competency because you're going to need it absolutely forever. If I had $1 for everybody who said, here's my plan, I need this $100,000 of capital, and that'll be the last capital I ever need. If I had $1 for that, I'd be rich, right? It's just everybody thinks that, nobody's able to do it. So diligence takes time and money. You want to get diligence ready. You need to put the right documents into some sort of a deal room, some sort of electronic deal room. Keep those refreshed constantly. That should be something you do very early in your company's life and continue to do that all the way through your company's life. You're going to need to get good at the art of negotiation because every layer of that stack has to get negotiated, and it's going to get negotiated multiple times over many, many years. And then you always have to have what's called an alternative to a negotiated transaction or a plan B. Because we will often, and I know everybody does this in the capital stack, we'll often ask the entrepreneur, okay, this all looks interesting, but what are you going to do if you can't get this layer of capital? And so the answer always has to, the entrepreneur always has to be thinking creatively about that best alternative to a negotiated transaction. And that's the way that you even out that he who has the gold makes the rules kind of dynamic. Because if you've got an alternative that doesn't require that gold, you've got a plan B, then you can hold out longer, you can work around, you can do the kinds of things you need to do operationally to keep things going. So it's really important to do that. And whatever, I don't know whether a question was asked because I missed the panel piece of this, but I'm sure there was a question asked about how long it takes. Somebody asked that, yeah. Whatever they said, double it or triple it, in my opinion, it's just if I tell you something, double it or triple it, it will take 2 or 3 times as long. The more players you have in the capital stack, so this is dynamic number 4, the more complexity there is. Every one of those layers has human dynamics associated with it. My business partners accuse me of looking at financing from a sociological lens, and that's true. This is not about the numbers, this is about the people behind the numbers in each of those places. And so the human dynamics at work in terms of egos, in terms of perceived intelligence levels and so forth, and that the capital stack can work at cross purposes to each other depending on how they all get along. There can also be a misalignment of interest in the capital stack. So a great example of that can be a preferred stockholder who realizes that the entrepreneur has now taken out a senior debt line of credit of some sort and has personally guaranteed that line of credit, which most banks are going to want you to do as an entrepreneur. And suddenly, as a preferred stocker, I go, uh-oh, the entrepreneur is now guaranteed a $1 million or $2 million line of credit personally. And gee, I know enough about that entrepreneur to know that they couldn't come up with $1 million or $2 million to pay it off if the business fails. And so how is that going to affect their behavior? I'm a preferred stockholder. I want them to grow. I want things to happen. So all of a sudden, they're guaranteeing $2 million worth of debt. So what do? Natural human behavior. They either take more risk than they should, or more likely they take less risk than they should. So those dynamics have changed in the capital sector. It's like one example of how this can happen, but it can happen in 100 different other ways. Someone asked a control question in the audience earlier, and I would say that the more capital you have, the more layers in the capital stack, the more difficult it is to figure out who really has control. And there are going to be tribal alliances within that capital stack. Can certain members of the capital stack team up in order to affect control and change within the company if they don't like the way it's going? The answer is yeah, that's probably the case. So even if things go well, this is going to be complicated. And if they go poorly, it's going to be a nightmare. So, like in a perfect world, the capital stack would basically be one layer or two layers, and I realize that's almost impossible in these days. But just understand, the more layers there are in the stack, the more complexity to manage, the more likely when things go off the rails, you don't need the permission of just one layer of that stack. You need all of this different permission in order to just be able to do what you think is right for the company. The capital stack dynamic number 5 is you always have to be thinking at least one move ahead of this. So whatever capital you're putting together today that you need for the next 6 months or the next year or whatever, you have to be thinking, okay, but now, once I've used that capital and taken the company to the next level, what's the next piece of this going to be? And you've got to be positioning your company in order to attract that type of capital. And you may find when you start to think about that, that you realize that that then informs who would be the right capital player in your current capital raise, because some of them are not going to necessarily play well in the sandbox together. So if things go well, what's your next step? If things go poorly, what's your next step? And then build a relationship with those capital providers early, before you need it. Back to my point of the best time to be raising capital and talking about is when you don't need it. And what this really comes down to is that you are constantly crafting your story, the story of who you are, who your company is, where it's going. You're constantly crafting that story as it evolves, and being able to translate that as part of the obtaining of the next capital stack. And that's going to continually evolve. Whatever you thought your company was 2 or 3 years ago, it's probably different today than it was back then. So your capital providers have to move along with you, and what you thought might be your next layer might change and all of that. So those are the 5 principles. This is stump to chump time, so I'm happy to take any and all questions. I don't have a brother, so I can't stump to chump with my. Don't finance like my brother. All right, who's first? This is a poor test if nobody wants to.
At what level of revenue and size and scale of employees do you really start seeing a lot more complexity in the capital stack? Because I think just a lot of times I'm giving a loan to a vegetable farmer or something, so we're only talking a couple of layers there. But where do you really start to see what size of company where this begins to get more complex?
I think in Vermont it happens in the $1 million revenue size range. I don't think it has to be that big to get there. And in part, it's because there are less kind of players within each of those pieces of the stack, and therefore they are typically doing kind of smaller deals. And so the capital you need to get to $1 million in an early stage might need to come from multiple different sources and multiple different areas. So I don't think you have to go very far to get there. But to the point of, just to use your example, let's say it's a farm or a grow operation of some sort. You might have an equipment loan provider that's one entity. You might have someone that's financing your, seed and early part of the production in some fashion. You might have another lender that's lent the money for the property. They may not all be one and the same, and you might have Uncle Harry or Aunt Mildred get going, right? So you could be really early in the phase and have 4 different levels that are part of that.
One of your dynamics mentioned becoming an excellent negotiator, and I wonder what tips you might have on testing out your story on family members, or testing it out on your attorney, or how you recommend that.
Yeah, I think you can, the beauty of Vermont is it's a relatively small state, and that means you can get around to, well, events like this, but all kinds of other events and so forth, and you can kind of rub up against other entrepreneurs and multiple different sources of capital providers, and you can make kind of a very simple and easy pitch. It's not really like, you're not really asking for anything, then it's more just, hey, here's what I'm thinking about, here's where I am, here's what I want to do, I'm thinking I might want a loan, or I might want X. What do you think? And try to get some feedback. So I think there's a way, and you should do that as often as you can without disclosing super proprietary or certainly confidential information or so forth, but just to kind of get a feel for what resonates with that particular capital provider. So I would do that absolutely as often as you can. And then based on the reactions, if you're watching the body language and kind of also what they're saying, I think you can begin to formulate, all right, what would, if I push them, what might they come back with as a offer over time, and how would I think about what it. But again, the best negotiating tool you have is not necessarily needing that capital.
I can add some context on that. Sure. You're kind of just always having half conversations, right? You don't just apply for a loan by you decide you're ready and you go to apply to 5 lenders. That's part of the relationship management that Carmen was already talking about, building relationships. And so as you're always kind of talking with folks about where you're at and things you're thinking about, and you start to sense some interest, or they start to say, actually, we have a program that is pretty interesting about when you're ready, let's talk. So actually, maybe we should talk next week. So you're kind of always having conversations, and some of the ones that are more natural fits just progress.
Yeah, good point, thanks. Janice?
So we tend to talk a lot about successes and how to be successful in raising capital. What happens when things go south, and you talked about, and it becomes the nightmare? What's in your experience, what is the entrepreneur's responsibility for helping wind down the business as well as the investor and in many cases lenders? How have you seen things work well in winding down a business if that is possible?
Yeah, I wish I could say I've seen a lot of things go well and wind down.
But there's ways to be honest about it up front and work together. So
yeah.
I guess that's what I'm getting at.
My suggestion would be, again, signaling, transparency across the entire stack so everybody gets the same information at the same time, so they know when things are going to be a problem. The next suggestion would be trying to bring all the capital stack players into one room at one time and talk through the reality of where things are and figure out who is going to want what out of this. If you have a senior lender that holds the first security position on all the assets of the company, and that senior lender comes to a meeting like that and says, you know what, we've just decided we want out and we want the business to be liquidated now, and we're going to grab the assets and go ahead and liquidate. Then, great, the rest of the stack, is either got to buy the bank out in order to keep going, or they've got to somehow or other try to, go to court to prevent that from happening. Good luck with that, right? But I think getting everybody in the room at the same time to tell that story and to begin to talk about things is helpful. Even if you do that, you're going to end up negotiating with each of those stacks separately, because nobody in their right mind is going to be in that room together and formally agree to do something. Probably it's not going to happen. They're going to be like, well, maybe, but I got to go talk to my, board or my lawyer or whatever. There are what I would call hard money lenders too, or term money lenders. There are folks out there, not so much in Vermont, but outside of Vermont, that might be able to do some recapitalization in a really troubled situation of certain companies, but not everyone. Yeah, when things go wrong, it's a problem. Now, you asked another point in there, which is how much, like, do the investors feel an obligation to wind down the company? Yes and no. Depends on how the company's structured, but most times the equity owners are insulated, at least legally, from claims and so forth. So if the investors have to get together and pony up, I'm making this up, $25,000 to do the final tax filings and other stuff, yeah, maybe they would do that. If the company is truly bankrupt, or should be bankrupt, the equity investors are likely, at that point, to not even show up for that meeting that I'm talking about, because they've already written it off in their mind. Lori, I think you had a question.
It was pretty similar to that. I was interested in you sharing any stories of when it's worked really well to work with other members of the capital stack, or a nightmare, whichever you choose.
It's generally a nightmare, in my opinion. And I think the only time it works together is when the more thoughtful that capital stack has been constructed, and the more they have, those members of the stack have worked together before, and have good relationships, the more likely it is not to go off the rails. But if you've got if a finance company has come in a layer above us and we've never heard of them before, unless we build a relationship with them and things go off the rail, they don't know us, we don't know them, we have no idea how they're going to react or not react, and so everybody gets defensive in that case. I'll tell you one kind of, the story that I think is, from my perspective, the most difficult. I was at a later stage, or we were in a later stage deal. It was like a Series C preferred stock, so that means there were already like 3 layers of preferred stock. There was mezzanine debt from 2 different providers. There was a senior bank relationship. And there were founders and common stockholders. And within the equity stack, the preferred equity stack, there were maybe 7 or 8 different, mostly institutional investors, and we were on the small side. And the company began to struggle, and struggled more and more and more. This was kind of mid-2000s. And there was a 12-person board. And I think 6 or 7 of those board members were appointed by the different classes of preferred stocks. You had a bunch of investors sitting on the board. I actually happen to be one of those. And then there were 3 industry experts who had run companies in the same exact industry at the multi-billion-dollar level. So they were all gentlemen, they were all folks that theoretically knew what they were doing. And then you had a couple of management folks on the board. When the company started to go south, all of the preferred stockholder board members quit the board, formally resigned, leaving the 2 smallest funds, me, because I didn't know what I was doing back then, or I would have bolted probably too. Right? So now the board, and all those outside experts, all they saw was liability. So they left the board. So now there were the 2 smallest funds, and the guy who was the CEO who had no choice but to continue on. So what was an 11 or 12 person board was now down to 3, except every major decision that was required, and the company was essentially insolvent at that point, so it needed major decisions literally every day, had to be approved by all of those stockholders who had resigned from the board and were now just being obstructionists and trying to elbow each other out of the way for whatever crumbs might be remaining. It was a nightmare. And then the mezzanine debt layer, it turns out, had what are called make-up warrants, which basically meant that even if they paid off the senior debt, the next layer that would have gotten money was the mezzanine debt folks. And they had a hurdle rate IRR that basically meant that it was almost impossible for us to realize we were going to get anything out of that deal, because because they were going to get more and more warrants that would flood the whole situation, right? So the entire stack was screwed up right from the get-go. And actually, that's when I first began, like that experience began getting me to think about everything differently in terms of how you layer the stack. So, you know, awful story. We're talking about a company that was really only $20 million size at its big. It wasn't that big a company, and it got to that level. Jordan.
Have you found, from your experience, a correlation in the complexity of the stack versus the success of a company?
Yeah, the more complicated it is, the less it's going to be successful. I really believe it. I mean, and because what's going to happen at some point is that, to your point, I think it was you that was making the point about, if I'm spending all my time managing the ongoing financing, I'm less likely to operate the business. So the more layers, even when things are going well, it's still complicated, the more time. So unless you have and maybe you guys are at the size to be able to do this, and Sivan's lucky because he came out of the CFO world and the finance world, so you've got a founder who actually understands finance. So in your case, that's great. But you know, you really need someone in the company that is, or maybe even a couple of people that are full-time working on the next financing and the next financing, and managing the stack on a day-to-day basis, so it doesn't get out of hand in some fashion, which is difficult because, you know, in Vermont, you know, you can have your founder CEO happens to bump into somebody in the grocery store and tells them one piece of news that they take alarmingly, and they go tell 3 other people that piece of news who are also in the stack, and you're trying to control the stack if it was your job. So you got to keep your CEO on and founder on message, right? And it's an ongoing job. So am I giving you indigestion? Is this good?
This is good.
Other questions, Dave?
When you're going for new financing, how much resistance does the current stack sometimes give there? Is there a relationship management that they need to be in the loop before you even go start talking to people?
Yeah, almost every, so if it's a lender, the lender might very well have some sort of provision in there that says you can't go get a loan from somebody else. So if you want to get another loan, you better go to that lender first. The equity investors very well may have what's called pro rata rights, meaning if you're going to go take in other investment, then we pro rata need to be able to purchase a portion of that. And they may even have veto rights saying you can't raise more equity capital without our permission. So in those provisions, you can find that conflict, right, in the stack. You might have some investors that have veto rights and pro rata rights and some that don't. You might have different lenders that have different rights. And so you pretty much have to get your entire stack engaged, get them on board with a particular plan. Now you've got to go try to knock down that financing and really get it. But you're probably going to pivot and change because you're going to get information back that says, well, we can't really do that, but we can do this. And now you got to go back to all of the stack. Right? It's complicated. Makes you all want to just be small, right? But that's not really my point. My point is you can do this, and there are people that can help you in Vermont, but you've got to think about it from the get-go, or it will mess you up. It'll mess you up down the road.
Carmen, so I'm a business, and I've got a $10 million gross cash flow a year, and I'm kind of bumping along, and all of a sudden someone points out that I've got 15 unrelated loans and equity that I don't even know where it is anymore, and I've been so busy growing my business that I've not really paid any attention, but suddenly I realized that I have an opportunity and I have no way to capitalize on that opportunity because I don't even know who I owe what to and when. Where do I start if I've been an entrepreneur and I've built my business and I've borrowed for this and I've borrowed for that, and now I need to make some changes. Where do I start?
But I think if you don't have a CFO, that's the time to get one. It seems like the first thing I would do if I was in that situation is say, I need a financial professional to step in here and sort this stuff out for me and help me come up with a plan as to how to go about this. And if you're describing a situation where things have actually gone well despite the chaos, and if that's truly the case, then there would be a lot of opportunity to recapitalize that stack. One lender that takes out all the other lenders, for instance, equity provider that comes in and rationalizes the capitalization table. So in that case, things I think could work out, but you need someone who actually knows how to do it. Or you need to get so educated yourself, which, is going to be difficult for a lot of people. I've spent my entire life financing companies, and I learn something new once a week. Sometimes it's joyful, and a lot of times it's painful. It's just what happens.
Well, then the related question to that is I'm bumping along and I'm making my $10 million a year and I'm doing my thing, and suddenly we have a change in the economy, and it's entirely outside my purview. It's not even regional. It's something that's just showed up, and I'm going to have to adjust to something that hasn't even been around in my business lifetime, and I need to start sorting through new things, and I don't even know what they are, let alone how to address them. Where do I start with that kind of a situation?
Well, I would say as a really good entrepreneur should be able to think, here's my budget this year, but what happens if the economy goes off the rails, right? So if you're not already doing that, I think as an entrepreneur you have to get into that what if scenario, and you should have, a handful of things every year that you're saying, okay, if this happens, what's my response going to be, as opposed to waiting and being reactionary. I think if you're reactionary, I still think you need good advice. And maybe in that case you would need some operational advice and so forth. You need either good employees or good advisors, but I think you've got to get good at being able to dream up the 4 or 5 things that are going to potentially damage you, that could happen, and come up with some plan ahead of time.
I guess going along with that question, how often have you seen something come out of left field that no one expected?
In the regulatory world, yeah. So in other words, depending on the industry, you guys have an industry that has some regulation, right? You can easily, even in fairly mature industries, you could easily get a new and different regulation that pops up, more so maybe in Vermont than other places from a state perspective, but from a federal perspective, that can happen. That can happen constantly. So that's certainly one place. And then major, I think all of us might believe, well, how far up does, how good is this economy? This is the longest, recovery in X number of years, or whatever the stats are, right? And when's that going to stop? So we all believe sooner or later it will. But what if 4 or 5 things tripped up the stock market, for instance, which falls, which then makes people nervous, so they start to pull back. And what we all expect to happen is happening, but now let's say it's this March or this April. Are you really ready for that? Well, most of us aren't. We know it's going to happen sooner or later. But have we really got the plan in place for that? And in large companies, what they're doing, right, if they believe that things are going to turn at the end of this year, large companies are already going out and securing the financing, right? So they're stockpiling, they're either stockpiling their own cash by making certain operating decisions, or they're going out and putting in place the lines of credit and drawing down on cash, just sort of waiting. It's just cost of capital to them, but they're waiting because they believe things are going to get worse before they get better. Small businesses can do a bit of the same thing, but don't maybe have the credit capacity to do that. Other questions? Anybody want me to leave you on an optimistic note?
Karen?
Yes.
I know you're talking about the capital structure, but how soon should folks engage an attorney and CPA as they start a business?
Well, I think you need an attorney. Maybe you can file your incorporation papers yourself, or go to the Secretary of State's office and do that. But sometime fairly soon. So if you're going to bring in, if there are going to be multiple co-founders, you need one right away. If you're going to have some early hires, you need an attorney, right away. If you believe you're going to raise capital, particularly equity capital, I think you need an attorney that has done that kind of work before. So, all attorneys and all CPAs are not necessarily equal, even though they have a designation and a license to be able to do that. And most attorneys and most CPAs practice within the areas of their experience, because they're ethical folks. But you can occasionally get somebody who doesn't know what they're doing, but remembered from law school that, oh, maybe this is 20 years ago what I learned, I'm going to try to do it that way. And I think the same thing's true with your accountant. You're going to want, if you have an entrepreneurial company and you're going to end up building a capital stack, you want an accounting firm that also has familiarity with that, which is going to be a certain level of sophistication. But yeah, early on. And I know from our perspective, we're always asking somebody, almost in the first meeting, if we're interested, we're always saying, well, this is interesting, we want to continue to do some diligence and so forth. Hey, do you have an attorney and do you have an accountant? Who are they? Because if there are certain folks, we go, that's the problem, and if there's others, we're, okay, good, that's really good, that's great. Because we actually want people on the other side of the table when we're negotiating, that actually we want the founders and management team to be sophisticated. We also want their attorneys to be sophisticated. It's a lot easier when everybody knows what the playing field's supposed to look like. It's a lot easier to get a negotiation figured out. Where if you have, one of the first deals we did 19 years ago, we actually didn't do it, and we didn't do it for this reason. They had an attorney who was not familiar with early stage outside financing equity deals. And so they were presented, and by the way, most if you go to a bank, those documents are really standardized. It's generally a software company called Laser Pro. I think it probably still is, Mike, yes? Yeah, Laser Pro. There's very few things that get changed. They're uniform documents almost all across the country, tweaked a little bit from a state perspective. So you've got kind of limited things to negotiate there, other than interest rate and amount and so forth. A lot of those other provisions are fairly standard. That's true really at every layer of the stack. So therefore, you can educate yourself on what's normal or not normal, and your attorney and your CPAs should also be educated. And the example I was giving, on the other side of the table from us was an attorney who had never seen an early stage equity document. And we were using what were called, and still are called, model documents. We could actually go online and find the model documents. And I will often say to entrepreneurs, hey, if you want to understand the provisions, here's 3 or 4 sites where there are model documents. You're going to see those, get to know them, and your attorney should know them. In this case, the attorney didn't know them. And so the attorney started basically said, well, we can't use these documents. This isn't it. You're going to have to do something else. And we said, no. This is like thousands and thousands of deals are done with these documents across the country. You can go online and find them, even 19 years ago. Well, we're not using those. Okay, well, we're going to have, it's going to be difficult, right? And so, we went along with it for a little while, then we just realized this guy doesn't even know what he's doing. So he's giving his client poor advice, and it's much easier for us to just say, we're done. This isn't going to work out. This isn't going to be a good relationship if you're starting off working with someone who really has no idea how to help you. So one example, a long time ago.
If you're an entrepreneur and trying to learn about all this, are there books that you recommend or online resources where I could go online and just read up what a SAFE agreement is, how typical financing works? Just these terms?
So the National Venture Capital Association, NVCA, has model documents for preferred stock and all equity transactions. So if you're ever going to get venture capital, they're probably going to start with those documents. Convertible debt, you can go, because I've done this recently, you can go Google convertible debt, and there's 3 or 4 kind of reputable providers of standard convertible debt notes. If you're interested in SAFEs, which is simple agreement for future equity, the Founders Fund which is an advisory organization, has a SAFE. It's literally a fill in the blank. You can actually do a SAFE yourself, believe it or not. Because a safe, you don't have to go to the SEC, it's crazy. But that's a rabbit hole we can go down for a long time. So the answer is yeah. I think most bankers, I don't know, maybe it's been a long time since I've been a banker, but I think most bankers would be happy to go over the kind of laser pro model with folks and say, here's what's going to be, like, when we get there, here's the covenants you're going to have to agree to, and here's what you're going to have to represent and warranty to us. So I think you can do a lot of that work. It's, some of those documents are deep and complex and so forth, but they are accessible. I mean, I had to teach myself a lot of this. It's just, there isn't especially years ago, there wasn't like a place that you just sort of went and could figure it all out. You had to go along. And I think you want a capital provider at any layer that's willing to have that conversation with you and is willing to show you transparently, here's what we're going to want you to sign and why we're going to want you to sign it. And if they're just like, hey, sign this, then no.
Any other questions?
Anything else?
Thank you, Karen.
Want the display back? Want this up?
Yeah, you can just put it.